see growth at a solid rate. You see inflation coming down, and you see a labor market that's still at very solid levels.
And that's the Fed chief who goes big with his first rate cut. In fact, good morning to all our viewers. It's a morning after the Federal Reserve chief cut rates more than expected. I think, Tamanna, Niraj, this has been one of the most anticipated and telegraphed starts to the rate cycle in our times.
Yeah. Most certainly. I mean, I think, telegraphed is the right word. 50 basis points in line with maybe what a lot of people were anticipating, as Peter Maguire said, that some quarters talking of 75. And I was thinking, what? Wishful thinking, really. But this is great
were talking
news.
about 25 basis points.
Yeah.
This is a positive upside, definitely. Now, it's what we're going to do in the first half of the show today is break down for you what this means for you and what really has happened. And we have a superb lineup this morning. But before we get to our guests, let me just take you through the key points very, very quickly. U.S. markets overnight, of course, moved to record highs after the Federal Reserve announced a 50 basis points cut, but ended up lower. They ended lower maybe because of a bout of profit booking, also because of one statement that the Federal Reserve chief made, and I'll come to that in a second. But let's just tell you what the Federal Reserve has actually done. They've delighted with a 50 basis point cut. It's the first cut since March 2022, and it is an aggressive one. The federal funds rate is now between 4.75 to 5%. The dot plot indicates a 50 basis point cut, a further one just in 2024, and a total of 2% by 2026. Now, what a dot plot is, in a sense, an amalgamation of what all the heads and the members of the Committee of the Federal Reserve think, and that is not a certainty, but definitely a positive indication. Look at that one quote from Jerome Powell that I've picked, and maybe that tells you why U.S. markets ended up lower. He says, no one should look at the 50 basis point cut and say, this is the new pace. So that slight tempering might have led to what you saw in the U.S. markets. Just two more points from the Federal Reserve, which are important to highlight. The unemployment expectation that the central bank has set has now gone up from 4 to 4.4%, while the inflation outlook is down from 2.6 to 2.3%. So that's also telling you that a new problem has cropped up in terms of what the Federal Reserve now has to handle. The 10-year, meanwhile, climbed to 3.7% after the cut. Crude has closed lower post the action, Brent at $74 levels. Gold, in fact, came off its highs as well. And Asian markets have opened higher. We'll just pull up quickly what's happening with Asian markets, all of them zooming. The Nikkei up about 2.5%. Quick look at the implied open to see what the morning is looking like for us. And we're not really breaking out the party hats yet, but about 37 points up. But let's just get a sense of the impact and implications of what has come out from the Fed yesterday. Robert Sakin, senior global economist at Citi Research, with us this morning. We're also speaking with Kenneth Polcari, chief market strategist at Slate Stone. Welcome to both of you, and absolutely delighted to have you on this very important day. Robert, let me start with your take. Were you pleasantly surprised with the 50 basis points? And does it matter that the Fed chief says don't expect this to be the new normal or the rate of cuts that we will see going further?
Great questions, and thanks so much for having me. This was a very close decision for me going into the meeting. I was torn between whether they would do 25 or 50. And I think what we heard from Powell is really this was kind of what sounded like a risk management move, that they feel that they made enough progress on inflation and they feel the economy is in a solid place, and they want to do something to ensure that the economy stays in a solid place, and that they will continue to get what they feel is a soft landing. So that was, I think, the messaging that we heard from Powell, which I think was very good messaging, because my fear was that if they went 50, it could signal that they know something that economists and markets don't, that they're more concerned about the economy than maybe justified by the recent data. But instead, they took the path saying that they still think they're soft landing. You see that in their forecast. And this is really to kind of get the ball rolling in a significant way. But may not be needed beyond this meeting. It'll depend on how the data evolve. So they started off with a 50, but right now, even with a little bit more rise in the employment rate, they're saying that they'll go 25 after these meetings. So I think Chair Powell did a very good job of explaining the logic, and overall was pleasantly surprised by the move in the meeting.
Okay. Kenneth, I don't think agrees with that, maybe because from what I heard or saw his response, Kenneth, you think that this was 50 basis points, too much?
I think it's a crisis move. Look, I was under the impression we were going to get 325 basis point cuts in September, November, and December, which I thought was perfectly okay. Going in 2 weeks ago, going into the meeting, I think that was really the sense on the street that was going to be 25. And then you could start to see it. They started getting pressure from elected officials. I think they got pressure from the White House. And then they were in a quiet period, so you couldn't hear from anybody at the Fed. So how do they do it? They kind of leaked the story to test the market at the Wall Street Journal. You know, Nick Timrose wrote an article on Thursday questioning 25 over 50 and was it really going to make a difference? And then on Monday, you had the big banks coming out and saying it didn't make a difference. It was irrelevant whether the move was 25 or 50. And then on Tuesday morning, you had the Wall Street Journal come out with another article basically demanding a 50 basis point rate cut. And what did the market do? The market didn't get nervous. The market didn't sell off. And so I think that Jay Powell came out today. He told us the economy's strong, inflation's coming down, the labor market's strong, but we need to make a crisis type of rate cut. It doesn't make sense. There's a disconnect there. And so it is what it is. They did it. It's fine. We saw how the market reacted. At first it rallied, then it sold off. I know futures are looking higher right now, but I think there's going to be a little bit more digestion of his conversation, of his speech. And then I think, we'll see stocks back off a little bit going into what is now a chaotic and confusing election that is just 6 weeks away, which is the other thing. For the Fed to make such a dramatic move 6 weeks ahead of the election really brings into question, are they pandering to the Democratic Party, right? Because that's clearly what it looks like.
I'm just going to take on from Kenneth's point. It's Samina joining in. Robert, that question is for you. In the last few decades, the Fed has done a 50 bips rate cut during crisis, during the COVID pandemic and during the financial crisis. Do you feel like this is just simply good politics? Because I think politics at this stage is going to be far more important in terms of the economy than the Fed action.
Yeah, and it's a great point looking at history. And as you said, jumbo moves are typically thought of in extreme scenarios, in crises, as you noted, when they cut by jumbo amounts, or if you look early in the cycle where they felt they were behind the curve and were worried about inflation risk and started hiking by jumbo amounts. So really, this is an atypical move to start off a cutting cycle by this size in a period where the economy is holding up relatively well. We have a low jobless claims, so we're not seeing layoff activity. The level of the unemployment rate is still fairly low, and the consumer is still spending and not really showing signs of rolling over. So I do think that the fundamentals would suggest that this type of move would typically in the past not have been explored. But I think it is not politics that is driving this decision. I really think from looking at Powell's communication today that they felt that they should have cut in July, is my read of the tone of their comments. And now that they've seen so much progress on inflation and the economy holding up well, that they decided to play a bit of catch up. And that's why they have the large move today. So I don't think at all it's politics driving it. I think it's the fundamentals, and they feel that they probably should have moved in July. Powell even hinted at that a little bit when asked if he would have cut in July had they seen the labor market data at that point. So I do think this is somewhat of a catch-up move and somewhat of a risk management move, and rather than a political move, which I don't think it is.
All right, Robert, I just want to come to a bit of detail of some of the commentary from the Fed and the implications thereof, where the focus now seems to be moving to the labor market data, versus inflation. Is that a fair assessment to make? Because look at their forecasts. The unemployment forecast not looking as good as the inflation forecast. That question for Robert. What does that mean in terms of the kind of action and focus we will see from the Fed?
Yeah, absolutely. And as you said, it's really about the labor market now. I don't want to say they don't care about inflation at all, but you had heard from Powell's Jackson Hole speech that's really not as much about inflation, and it's more about downside risk to the labor market. And Powell even cited himself today, referencing his Jackson Hole speech, and really talked about how the labor market is squarely in focus. So I do think the balance of the mandate has shifted away from focusing on those inflation risks to really being concerned about downside risk to the labor market. And I think there it's very helpful to look at their forecast in the SEP, the Summary of Economic Projections. They're projecting a 4.4% unemployment rate by the end of this year. That's about 20 basis points higher than it is now. And with that, they're projecting 2 more 25 basis point cuts. So that gives a sense of how they're thinking about labor market conditions. If the unemployment rate were to move higher than that, you're likely to get more jumbo moves in coming meetings. So I think they gave a very good sense of how they're thinking about the labor market and emphasize that that's really their focus at the moment in terms of guiding policy, at least over the next few meetings.
Kenneth, a quick question for you. We've got that 50 basis point rate cut. I mean, I think the debate is bad economy or good politics. But that aside, historically, such an aggressive rate cut usually leads to an asset bubble. I know this is good for risk-on trade, but do you fear that too much too soon could actually spoil the party? And we saw that when we saw the dollar carry trade unwind. It didn't go down too well, if you remember. How do you feel this is going to play out?
So I'm a little, listen, I understand and I agree with most of what you just said, but I just think that this move, we're not in a crisis situation. The last time they made those jumbo moves was in crisis situations. Jay Powell made it very clear himself today, we're not in a crisis situation. So it's confusing to me that they cut rates as if we were. Now, that being said, they did what they did. It's fine. Now it is what it is, so we have to live with it. And the next couple of rate cuts should probably be absolutely no bigger than 25 if we get even 2. Maybe there's only 1 more this year, and maybe not. We'll see. But one way or the other, I do think that initially people are going to digest this. They're going to listen to what he said. They're going to pull apart his speech tomorrow. Everyone's going to be looking at it. I actually think that the market probably has a little bit more downside as it kind of readjusts. There's going to be some concern over is he really sure that the economy is okay, or is he cutting aggressively because he's a little bit worried, right? Because it could go both ways. He had a fine line to walk. I think he did a great job today trying to manage that, but I also think that there's that underlying worry that maybe the economy is weaker than he's letting on, and we're going to start to see that, and then that's what's going to turn into a bigger negative situation. But look, here's the other thing. If it doesn't and the economy stays fine, this aggressive rate cut has the ability now to stir up demand and reignite inflation, which is exactly not what we want to happen, what he wants to happen. Because if that happens, then they're going to quickly turn into to raising rates again, and that will be very ill received by the market.
Wow, raising rates. I mean, that move could be, that answer could be debatable, but be that as it may. Let's work with that assumption that maybe that could happen too, because these days we don't quite know what will happen. Robert, my question to you is, from an emerging market perspective, now that we know that the 50 basis points is done, another 50, whether 25 or 50 or what have you, is on the anvil in the next 2 or 3 meetings. What happens to flows for emerging markets? Because that's what the Indian viewer would want to hear right now. Are there flows coming the emerging market way because of this move done by the Fed?
Yeah, it's another great question. And I think what we've seen in this cycle is emerging markets in many cases have found less scope to cut rates because the Fed has been higher for longer. And there have been fears about what that would do to flows in the economy's exchange rate. If you go back to earlier this year, it looked like the Fed was going to cut 5 or 6 times. And instead, those rate cuts got delayed. And we only just got the first cut in September. And over that period, many emerging markets that started cutting early had to or ended up cutting less than expected, or in some cases pausing their rate cutting cycles. And I think now that the Fed has cut rates, it's going to ease some of those fears and some of those pressures. And what you're going to see is emerging market rate cutting cycles broadening and picking up steam again. And so we're looking for many of these EMs to see scope to start cutting rates again without having to worry about those factors with the exchange rate and flows. And that includes EMs in Asia, where rate cuts have not really gotten started. But I think now that the Fed has started to move, that will open up scope for those economies to ease as well. So I think the Fed's move for EM means that some of those rate cutting cycles can start up again, and new rate cutting cycles can start as well.
Just a quick taking in cue from Robert and talking about what this means for India and simplifying this, because we've talked about, I mean, the whole world is talking about the Fed rate cut, and I guess the man of the hour, or the man of the last few weeks has been the Fed chief. Very simply put, a Fed rate cut, what does it mean for India? First up, the school knowledge or theory suggests that this increases foreign inflow into emerging markets. The reason being, investors that are seeking relatively higher dollar returns would look at markets outside their home country. So countries like India stand to gain. Apart from that, it does impact the dollar-rupee pair. Now, why do we say this, right? An influx of foreign inflow into India will affect the rupee. This is because if a foreigner needs to come into India and invest in our equity and debt markets, what they need to do is sell the dollar and buy the local currency. This, of course, in a broader business sense, means imports for Indian companies or Indians gets cheaper, but exports gets less competitive, which also means that IT sector, case in point, could stand to get impacted because buying from Indian IT companies may not be as cheap as it was when you had a stronger dollar. In terms of bond market, lower interest rates typically lead to a rally in bond markets. Indian bonds also may become more attractive as yields appear far more favorable. Apart from that, the big question is, will or will not the RBI move? Again, historically, we've seen that months after the Federal Reserve has moved with their rate decision, the RBI usually follows suit. The reason that's done is to maintain the rate differential between the dollar and the rupee. But let's also remember that the current RBI governor has time and again indicated that they will not move on the rate cycle unless there's a need locally, and they would not be doing it just because the Fed has done this. Kenneth, so this question comes to you next. There's a whole debate about whether or not in the near term money will start flowing into countries like India. The only argument I have here is that while we've been anticipating this, there have been some markets that have seen aggressive foreign inflows coming into the equity and the debt market. We saw that on the emerging market index too. But I think the argument for India has been that it's an expensive market. Do you feel like valuations will play spoil sport and foreign investment may not very quickly find its way into India?
You know what? I do think that it may not find its way immediately, right? There's going to be a recalibration based on what the Fed has just done, what the Fed's going to do, how that's going to impact the dollar, and how it's going to impact the EM markets, right? The emerging markets, whether it's India, whether it's the other EM countries, and what they do with their rates. And so I think we're going to have to watch and see how that happens. I don't think it's going to happen quickly or immediately. And to your point, a weaker dollar is going to make your products more expensive. And so therefore, if they don't bring that in line, then that differential is going to stick way out, is going to be probably a hindrance or a headwind to new money coming in. But if India and the other EM nations come down, they start to keep the differential the same. And so therefore there doesn't end up being a big difference. Then I think, yes, there's more of a possibility that opportunity and money will come into places like India, which are very, very hot and actually very exciting at the moment in terms of opportunity and what's going on there in your markets, in your sectors.
We're short of time, but very quickly, Robert, quick question. What does this mean for gold, base metals and crude? Up or down, positive, negative in the near to medium term?
Yeah, absolutely. On the gold and metal side, we saw gold rallying and the potential for a larger move heading into this, and then it really depends, I think, on why the Fed is cutting rates so rapidly in this environment. Is it the soft landing scenario, as the Fed has been saying, and I still think is likely, or is the Fed cutting because we're in a recessionary environment and they're going to have to cut rates very rapidly, and that could lead to more flows into something like gold. So I think, again, for that, it really depends on what the driving factors are. For energy, we're looking, our commodities team is bearish oil and thinks that oil is going to continue to fall, and Brent's going to fall to something like $60 a barrel over the next several quarters. And that's really in part based on slowing global growth, particularly in developed markets. So you can't group all commodities into one bucket based on this move. It depends on what happens after this, why the Fed is doing the move, and what happens with the rest of the world. But I think base case on the energy side is oil's likely to fall from here. And gold, again, other metals, depends on the U.S. outlook.
Gentlemen, out of time completely, but thank you so much for being with us on the show today and giving us your thoughts. Really, really appreciate your time.
Thank you.
That's the global view on what the Fed could do and the resultant impact thereof. Now, what's the trade setup as a result of all of this? I think that's the key question, right? Indian markets, a la global markets, have rallied a bit, and maybe some bit of this, of Fed move, is priced in. But is all of it priced in? Maybe not. So one would reckon that Indian markets probably have some more legroom before the positive impact of this Fed rate cut gets priced in. And slowdown globally is evident. You can see the high frequency indicators, except for 2 or 3 economies. Most economies otherwise are looking like under a shade, and therefore that is a problem. But you probably see Indian markets rise a bit more. The only point is, what seems to be the order of trade? You stay away from global cyclicals. Maybe that is why IT corrected as well yesterday. You're seeing global cyclicals not quite able to deliver. Stay away from metals, therefore, because they seem vulnerable to spreads as well as pricing, and bet on domestic defensives, maybe banks. Maybe that is the order of the day. So that's to be watched out for. But that's for the medium term. For the short term today, I think the stocks to focus on is a very important one, because there's at least 9 or 10 that will react today. Samina, what do we start off with?
Yeah, we've got a whole bunch of them, and it's all about QIP. That seems to be the theme this morning, while, of course, the bigger theme remains the Fed rate cut. Implied Nifty is indicating to a positive start. Like we've said, Asian markets are looking great, so the setup not too bad in early trade. Well, on top of the list is going to be NTPC. There is some good news coming on that front. NTPC Green has filed the DRHP to raise 10,000 crore rupees. IPO is going to be an entire fresh issue of equity and no OFS component. Funds will be deployed for loan repayment and general corporate expenses. 7,500 crores will be used for repayment of debt, and 2,500 crores will be for corporate expenses. Repayment of debt will mean lower borrowing costs, which also will impact the operational performance of NTPC Green. The company's net profit currently stands at 138 crores. So watch out for this one. There should be a direct impact on the company stock. Well, the other one that we want to look at is IRIDA. This was largely on expected lines, but of course it's formalized this morning, where we believe through an exchange filing that IRIDA is looking to raise 4,500 crores of funds. The initial fundraise is going to be done through a public offer or a QIP. So the route is not clear, but of course the plans are very obvious and announced. The government is allowed, remember, to dilute 7% stake holding via the QIP route. The current value of the government stake in IRIDA stands close to 46,000 crores. So government stake sale on IRIDA is one you want to track. The stock could be a mover in early trade. Talking about stake sales, you've also got GE T&D. The promoter here is looking to sell 15.6% stake via an OFS. The sellers are Grid Equipments, GE Grid Alliance PV, and the current value of the promoters is 15.6%. Current value is about 15.6%, valued stood at 6,581 crores. The floor price of this one is 1,400 rupees a share, so it comes in at a huge discount to yesterday's close. To quantify that, that's a 21% discount to yesterday's closing price. So lots of fundraising plans and a big IPO in the making. The season of primary market still not getting quite anytime soon.
Nowhere close to it. More fundraising and impact thereon in my watch list as well. I'm going to start with SpiceJet. I mean, the turbulence this stock faces is just unbelievable. So yesterday that stock was about 6.5% down. In part because of their filings, which revealed that there were statutory dues they owed upward of 600 crores, including PF, which they've not yet paid. But their QIP did close. It's a 3,000 crore QIP at a price of 61.60, so a discount, of course, to the current market price, about a 21% discount. It's the buyers of the QIP that will maybe enthuse investors. The family offices of Madhu Kela, Akash Bhansali, Sanjay Dangi, Rohit Kothari have invested in it. Think Investments, Tata Mutual Fund, Bandhan Bank, Discovery Funds, Plutus, Jupiter Fund Management. The fact that names like this have come in on SpiceJet is something that the market might like. And Niraj, this is something that you've been talking about as well. I mean, now what boggles the mind is why marquee investors would come into a SpiceJet when fundamentally the business of that airline has not been that great. But nevertheless, this is something maybe investors will take a cue from.
Yeah, most certainly. 2 days of a pullback after that 78 rupee up move. So it'll be interesting to see if this gets bought into because of the nature of the names, Tamanna, most certainly. But yeah, one would suspect that the story is being suggested to potential investors about the revival might be very compelling for such big money to come in.
Okay, so the thumbs up is simply because that if such storied investors buy that revival story or that revival theory, then is there something in it which makes sense? Nazara is the other one, and we spoke to the management a couple of days ago. In fact, before their fundraise, but they have now successfully raised 900 crores via preferential issue. Those details are out at an issue price of 954, so a discount to current market price. The capital infusion is to fuel strategic acquisitions and business expansion. Remember, they have made acquisitions. They've been on a spree, actually. They've acquired Pokerbazi, etc. And there's more to come, is at least what they very clearly indicated to us. Garden Reach is the next one. Garden Reach has received an additional 54 million contract from Carsten Rader for 4 multi-purpose vehicles, vessels, sorry, not vehicles. So it's a repeat order in that sense. It'll be completed in 33 months, and the total value is 108 million USD for 108 million USD for 8 vessels. So Garden Reach, which has been languishing, might see some up move today.
Yeah. And clutch of brokerage notes, Jefferies on Adani Energy, 38% upside, on NTPC, 17% upside. But the big news of the day, and that's the one set of stocks on my list, which is the liquor companies, because the Andhra Pradesh cabinet has cleared the new liquor policy, effectively retail being managed by private players. And the analysts believe, or analyst community believes, that it's about a 7 to 8% positive impact on volume growth, with beer having a much larger uptake. So FY26 apparently could see a strong uptake in volume growth, nearly about 14 to 15% for beer, and 10 to 12% YOY volume growth in prestige and above spirits. Now, keep in mind, Elara Securities has said that there's a mild positive impact of further 3 to 5% visible on stocks, because some of the stocks have rallied already. So that's to be kept in mind, but an uptick nevertheless. In fact, on that cue, let's get in Amit Dhanukkar. He's Chairman and Managing Director, Tilak Nagar Industries, joins us right now on the show. Amit, good having you. Thanks so much for joining in. How enthused are you by this? What changes from what used to be? Can you tell us?
So good morning, and thank you for having me on the show. Well, this goes back now to pre-2019 era, where the retail trade was private. So the policy note has just come out yesterday, where privatization of the retail is expected to kick in, along with a 10% increase in shops. So I think definitely this looks like a positive, because if we see the Andhra market from 2019 to 2024, it's actually degrown slightly, maybe 1% negative CAGR. So certainly we're quite optimistic that privatization of the retail trade and will increase consumerism, and should be good positive for national companies like us, which have traditionally had a strong brand presence in this space.
Mr. Dhanuka, good morning. Tamanna here. Just want to understand, and of course it's positive that a large market opens up, but how large is Andhra for you? Because you've launched a flavored brandy brand recently. You've acquired Prague Distillery. So trying to understand the importance of Andhra for the whole space, for the industry and for your company in terms of how much they contribute to revenues.
Andhra Pradesh has traditionally contributed around 30% of our total volumes. And going forward also, I expect that to largely be in that vicinity. Prague Distillery is a bottling unit which we acquired around 15 years ago. Since it was a critically large and important market for us, we felt it's necessary to at least have some owned manufacturing in the state.
Right. Amit, hi, it's also Samina joining in. While the number of stores will go up, what we want to understand is while AP is a significant market for you, like you said, 30% of your top line comes in from there, what can you quantify? What sort of a revenue increase are you anticipating from this move? And how soon will this impact your earnings? Is it going to be this quarter? Could we see the impact of this over the next 2 quarters? And also, would it impact pricing in any way and hence your margins?
So good morning, Sumita. I think that's a little bit difficult one to actually quantify at this stage, what benefits it would have going forward. But there has been talk and not confirmed yet that the government is also looking at a possible reduction in consumer price. That also could be a huge positive in terms of uptaking demand. But I think at this point in time, it's really difficult to, quantify what type of kicker it would have to growth. But, short to medium term definitely looks positive. I mean, when we always welcome consumerism and free markets, I think if the market overall also grows, I think it's positive for all companies. I think so. We are encouraged by that.
Given that this is such a significant market, and the last acquisition you made here was all the way back in 2014, would you be eyeing maybe a new manufacturing unit, maybe a new partnership, maybe increasing your distribution spread? And if yes, how would you look to do it and when would you like to do it?
So in terms of manufacturing capability, I think we are quite solid on that front because besides our own facilities, we do have secure contract manufacturing arrangements which will be good enough to cater to market demand. Our focus would be more on consumerism. Once the free retail opens up, I think it's all about communication and being available. So our focus will be on consumer demand. Our brand is traditionally very strong in that part of the country, Andhra Pradesh, in terms of, and brandy is quite large over there. 30% of the Andhra market is brandy. So I believe we would be positioned quite well to see benefit coming over the next couple of years.
Amit, just wanted to get the clarity on the volume growth. So analysts expect a volume growth of 7 to 8% to happen for companies en masse, so to say. What is your assessment? I mean, based on the market share or otherwise separately, but based on the existing market share that you may have, do you anticipate between 5 to 10% volume growth on that number?
Yes, I think that would be a reasonable assumption.
Reasonable assumption. So 5 to 10%?
Double digit we would expect.
Oh, you would expect a double digit volume growth from your current numbers in Andhra Pradesh, right?
From the current.
And this starts when? You would reckon the second half of the year could have that?
I think maybe even because it will take time for the policy to settle this conversion from government retail to private retail. There would be stocks at the retail level. We don't know how that's going to be. So
but FY26 for sure.
FY26, yes, I think, yeah, correct. There might be short-term hiccups, but long-term, I think the outlook is positive.
Got it. Okay. Amit, this is great of you to take time out and explain. Thank you so much for being with us and giving us your thoughts.
Thank you for having me.
Well, guys, an uptick today for sure. I mean, then whether or not that continues is separate. But double-digit volume growth in FY26, hopefully pricing issues won't be there for premium spirits because I think in the policy that they've said that the cheaper brands, they'll bring down the pricing to 99, but the premium brands won't be tinkered with.
That pricing will improve. It will increase demand. So I do understand that volumes will go up, but if prices are going to come off, you'd imagine your bottom line would get impacted. You know, even if you're selling more, you're selling
but
at a
for
lower
the
price.
Versus not selling at all.
In the
So I mean,
they have been selling. 30% of their business comes
Used
from
to be, but
wholesale and
degrowth happened last year by 1.5%.
now goes to pre-retail, but also just one last piece here that the premium brands, the pricing may not get impacted as much. The normal brands, I think the policy states that the readily, easily available brands, some of the pricing may be brought down.
Yeah.
Otherwise, no.
Well, encouraging more consumption of alcohol in Andhra Pradesh is.
No, I think you should look at it as options available for those who want to consume.
Yeah, organized.
Just make it easy.
And then of course it's everyone's choice. But I think it's a big day on the derivative side. Nifty expiry, Agam back from his break. Agam, and on a superb day.
Yes, it is. It has been. Big cut from the Federal Reserve standpoint. And at the moment, what we're looking at is a lot of unwinding in some of the key benchmark indices, at least as far as futures are concerned. I reckon a lot of traders may want to perhaps put a break just for now, and which is why we're seeing unwinding in the Nifty futures, about 3.5% decline in open interest there. For the Bank Nifty, again, we saw a 5% decline in open interest, but even as the index advanced by around 1%. So yesterday was a day of trade where banks clearly were the big gainers. Of course, when it comes to the options market, as we move into expiry today, we're looking at a lot of traction in and around 25,400, 25,500. That's where the calls are. On the lower end, we still have a significant amount of writing around 25,000, but that's just a bit away. That's the 25,000 put specifically. So all in all, we are looking at a roughly 500-point range. But since the Nifty is closer to the higher end, we're going to have to wait and watch. At the moment, of course, the implied open is looking at a marginally higher open. And the first 1 hour of trade will certainly give you a better indication of where we may head towards this weekly options expiry for the Nifty. But with that said, let's get an expert to who can perhaps tell us a little bit more about how he is looking at trade on the benchmark indices and where he's placing bets. So for that, we have Rahul Ghosh of Hedge.in who's joining us on the show. Rahul, good morning. Thank you so much for joining in. How are you looking at, indices pan out? And, based on the kind of calls that you've given us in the previous couple of weeks, how are you looking at things panning out now?
Good morning, and thank you for having me. Looking at the texture of the market, the Fed event was always going to be a non-event. The primary reason why I say that, because there was no run-up of the VIX for the last few days, and the only run-up of the VIX happened yesterday, that too only up 8%. So the event was not going to be a big market mover, which we got an indication yesterday itself. Having said that, the momentum in Bank Nifty is going to continue towards the upside. The last hurdle of 52,500 has been taken out, and 54,000 seems to be the next target on the upside. Keeping this positive stance on Bank Nifty and overall keeping the texture of the market positive, we've planned a bullish calendar butterfly, which I would like to go ahead and explain.
Rahul, so the way I looked at it when I saw your strategy, it looked like a debit spread in one series and a credit spread in another series. So can you just go ahead and take us through this one?
Absolutely, perfectly put. We had a debit spread or a simple bull call spread with one series. What we're doing is we are buying the 52,800 call and we are selling the 53,000 call. Like you rightly said, both are of the same expiry, which is the 26 September expiry. This is a simple bull call strategy, makes money when the market goes up. However, normally when we are hedged, we always keep fail-safe situations with us. So the fail-safe situation in this case is in case markets don't go up. To counter that, we have another bear call. So as you rightly said, this is a combination of a bull call and a bear call. The bull call, like I just now said, is the 26 September expiry. The bear call is of the following week expiry, which is the 1st of October. So we're selling the 53,000 call of 1st of October. And to hedge that, we are buying the 53,200 of again 1st of October. So the first set is 26th October and the second set is, 26 September and the second set is 1st of October. It's a simple butterfly with 52,800, 53,000 and 53,200 strikes. The risk in the trade is fairly low. It's less than 1,000 rupees. And the risk comes into play only when Bank Nifty moves towards the downside. If Bank Nifty moves up or stays sideways, which is our popular view right now, this strategy would yield money. The capital required in the trade is also small. It's about 32,000 rupees, can be 1,000 or 2,000 rupees here and there, depending upon your broker.
All right. Interesting. Rahul, I'm assuming there are no adjustments to this particular structure at the moment. We just play this whole strategy out perhaps towards the end of September?
That is perfectly right. So we most likely would exit this strategy on the 26th of September. In the case Bank Nifty moves down very sharply, what one can do is maybe roll down one leg of the sold call to maybe a 52,800. But ideally, 26 September is when you should look to exit the entire position. And hopefully when I'm back on the show, I can give you an update on how it played out as well.
Absolutely, Rahul. We'll be waiting for that. But on that note, thank you for joining us and taking us through your view on the market and also giving us that option structure to work around with based on your view. With that, it's back to you all.
Thank you for that, Agam. So, important day, expiry day, at implied open at least looking fairly positive and getting more and more constructive as we move towards the opening bell. So, 83 points up now on the implied open for the Nifty. So while the focus is on Fed, we'll see what happens to IT stocks. Do they get a drubbing today? Do NBFCs shine? And all of that happens. Remember, it's a lot of stock-specific news which is also coming in today. And one of the stocks that could be in focus is Adani Energy because of a note by Jefferies. Mehika is joining us with more details on that.
Good morning. So Jefferies has actually maintained its buy rating on Adani Green Energy at a target price of 1,365, which actually offers a 38% upside to its previous close. Now, it's met with management at the Jefferies India Forum 2024 and has the brokerage has noted that how Adani Energy Solutions is the only pure-play private sector listed entity in the transmission and distribution sector. The company currently has 70% market share in the transmission competitive bids, and management has indicated that while it has lost market share in the past few months, it will gain it given the robust bid pipeline of over 90,000 crores in the next 12 to 18 months. The management has also highlighted smart metering as a new high growth area for the company. And, this remains an exciting opportunity because smart has a bidding of 120 million smart meters. Projects are still left because of the government's 250 million target by 2026. Jefferies has also stated the capital management program focus is on reducing the volatility in the interest cost of the company via the long-term tenure bonds and execution-backed growth, and this is positive for the company itself.
All right, thank you for that, Mehika. So Adani Energy in focus, standard disclosures there, of course. But Jefferies has one more note out, which could see some impact on the stock. It's a positive one on Godrej Properties. They've maintained a buy with a target price of 3,725, implying a 30% upside. Quite a big bump up there. The reason is that they say the residential upcycle will be structural in nature and could last over a decade. They expect the company to deliver on their FY25 guidance and continue momentum into FY26 and 27. The raising take rates are improving. Mix and pricing should reflect in higher profitability. So that's another one that could be on the radar today.
Well, we've got some more there to add. In fact, a whole list of counters that will be in focus. Adding to Tamanna, Niraj, in my list is PL Kashia. Watch out for this one. It's a big order win to the tune of 221 crore rupees. Lemon Tree, once again, it's been a few days. They haven't announced a new licensing pact for a new property. This one, interestingly, is in Andhra Pradesh too. Garden Reach has finally bagged another big order for $54 million. And alcohol companies. AP is coming in with a lot of good news. Alcohol companies stand to gain significantly on the new liquor policy. Like Tilak Nagar said, they could be seeing a volume growth in double digits.
NTPC would be in focus. Aside of comments at the Jefferies conference, NTPC Green files for the 10,000 crore IPO, so watch out for that. SpiceJet QIP has investments coming in from Madhu Kela, Akash Bansali, Tata Mutual Fund, and more. And Adani Energy, as we just highlighted, a 38% upside from Jefferies, so could be a stock in focus.
Okay, some more that could see a buzz today includes GET&D, but a downward buzz. They are going to be selling 15.6% stake by an OFS, so picking up money from the market. Irida, the government will dilute up to 7% stake So you could see some of a hit over there. There are a lot more stocks that we'll be talking through the morning before we get into the opening rates. But let's get the first calls in from Shrikant Chauhan, Executive Vice President and Head of Equity Research at Kotak Securities. Nirav Shah joins us this morning as well, Head of Equity Research Analyst at Latan Manharlal Securities. Welcome to both of you. Very good morning, Shrikant. I see you already smiling. So are you anticipating some positive impact on the Nifty expiry day? The Fed has done more than what was expected. Definitely no reason to be disappointed. How would you play this?
Yeah, good morning. Good morning, everyone. I think, the Nifty was consolidating. It has been consolidating since last 3-4 days. And on Wednesday, before the Fed's specific comments, we saw a huge amount of volatility. But despite that, the market managed to sustain above the levels of 25,350, which was the highest of the previous move, which clearly indicates that the markets are still in strong hands. And we can see the levels of 25,500 or 550 in the near term. But if we go through with the option statistics, then there is huge amount of call writing close to 25,550 levels. If we see the market is crossing these levels, then the next level to watch out for would be maybe 26,000, 26,500. Because after that, I think there is hardly any major resistance which will stop the market. So broadly, I'm of the view that we are going to see higher opening somewhere close to 25,450. In case if there is any correction, then again, it will be an opportunity for short-term traders to look for entering into long positions. If there is a medium to long-term view, then certainly we should look for taking some long bets in this market because markets are still above their important support levels and consistently Nifty is forming higher top, higher bottom series, which is positive. So yes, if there is any correction, then certainly we should look for taking some long bets. But closing above 25,550 is something which will actually change the entire sentiment of the market.
550. We'll see if we get there today. But Bank Nifty, Shrikant, Bank Nifty was, like a wall yesterday, fighting back against all the nervousness in the market. Positive cues, at least from the Fed decision as far as the Bank Nifty is concerned. What would be your strategy here?
See, for Bank Nifty, it was expected since the beginning of this particular previous expiry. We were expecting that financials were doing relatively better than other indices. Even if we see the entire pattern of the Bank Nifty, then there it has formed a complete reversal formation, which was indicating that we can see the levels of 52,700 or 800, which actually the Bank Nifty managed. And the support came especially from HDFC Bank and few other private banks. But we are of the view that based on its technical pattern and the way FIs are consistently infusing funds into emerging markets since the last few days. Also, if we see the overall commentary from Fed, I think they are going to cut the rate 50 basis point further in next 2 meetings and 100 basis point in next 1 year. So all this will actually help emerging markets to do well in the anticipation that more flows will come. And in that, most of the time, we see specific buying interest in financials. So I am of the view that Bank Nifty is going to cross its previous high of 53,350, 370 levels. So again, strategy should be to look for adding position if there is any correction. Currently, it is very close to overbought levels. So it is advisable to buy if there is any correction. So close to 52,500, 52,300 levels, look for entering into long positions with a stop loss at 52,000. And on the higher side, again, we can see the levels of 53,370.
Bank Nifty has been quite the star recently. It's surged significantly in the last couple of weeks at record levels since what we saw all the way back in June. Nirav, good morning. Thank you for joining us. Nirav, now that the Fed rate cut is behind us, we've got more than anticipated or expected. Will this have a meaningful impact on the direction of Indian equity markets in the near term, or will we be back to seeking the next big trigger for some direction?
Yeah, good morning and thank you for having me on your show. I think it's definitely augurs well for the emerging markets, especially for India. And I think particularly the sectors to watch out for will be the high growth sectors. Typically, we have seen that rate cuts tend to benefit the high growth sectors, and there you have particularly it's beneficial for IT companies And this is what we have seen in the past also. And I think this is because on account of the fact that the lower discounting rates help to improve the present value of the future cash flows. So this is one important factor. And the other important factor is the banking sector. I think we can expect private sector banks to do quite well. And going forward with the transmission of the interest rates and the stance which RBI takes, I think it could be beneficial for the public sector banks also, because they could start reporting good treasury gains. So this is the immediate impact. And from an overall emerging market perspective, I think we are expected to get better flows going forward.
Valuations are compelling, that is a given. But for now, it looks like it's going to be maybe a slow and steady process till those flows start returning back to Indian markets. Shrikant, while I did hear your call on Bank Nifty and you said it's a buy the dip and 52,500, 52,300 is a likely entry point. Let's talk stocks. If not Bank Nifty, would you look at buying specific bank names? And ICICI Bank has had it good. HDFC Bank is trying to play catch up. PSU banks also not doing too badly. If not the Bank Nifty, immediately any banking or financial service stocks you would look to add today?
Technically, if we go through with this entire basket of Bank Nifty, then in that specifically we like ICICI Bank, but it is very close to its resistance level. In fact, since last almost 15 days, it was like just consistently going up and reached the mark of 1300. So most of these stocks are very close to their overbought levels. So if there is any correction, then certainly we should look for adding them. Sometimes what happens, like buy on rumors, sell on news type of trend we see. So today we may see some profit booking in bank stocks initially, but later again we are expecting a rebound from all these particular banks. But in that case, ICICI Bank falls to, let's say, 1260, 1265, then there we should look for taking some long bets. HDFC Bank has also crossed its important level, which was like stopping it since last 2 months. So again, if we see there is any retesting of 1675 or 1670, then there the HDFC Bank is having excellent support. And we also like Bandhan Bank. It was like relatively underperforming, but now it has started doing well. So based on its technical formation, yes, at current levels, it's a buy around 212, 213 levels with a target of 230 on the high side. And we can keep a stop loss somewhere close to 205. So if we really have to like participate in this particular financials, then Bandhan Bank looks good. Yes, there are few other stocks like Bajaj Finance, which is, I think, going to do well and going to hit the levels of 8,000. But see, fundamentally, it is expensive, but technically, it is showing all the chances of hitting 8,000 in the near term.
Shrikant, banking is, you have quite a few picks there. Maybe NBFCs will be in focus as well. Look at Shriram Finance yesterday. But what are your picks for this morning?
Yeah, I would like to go with few rate sensitives, like from the auto space specifically. We like Mahindra and Mahindra, and quite surprisingly, it is moving up. In fact, the stock has formed double bottom close to 2750 levels, and on a daily basis, if we see, then in last 4 days, it again reached the levels of 2800. Based on its technical formation, I think the stock is heading for at least 2880, 2900 levels. We can keep stop loss at 2775 for the same. The other stock which we like is from the commodity space, and that is NALCO, or National Aluminium, which is currently trading around some 185, 186 levels. There I'm expecting completely reversal sort of formation. And based on its formation, the stock can move towards 195 or 200. So again, here also we have a buy call with a stop loss at 180 on the downside.
Shrikant, quick one. Actually, Nirav, why don't you come in? We saw the sell-off on IT yesterday. IT's had a very good run, and it's up 30-odd% in the last 6 to 8 weeks. Was it healthy profit taking, or do you feel like the fundamentals are back, or are we back to being concerned and worried about the recovery in the US and the pickup in IT deal making?
Yeah, actually, what we've been hearing is that on and off we tend to have some negative news flows coming around the IT sector, because yesterday we had this news that some promotions have been delayed by Accenture. And in the past also we've seen the impact of artificial intelligence, machine learning, etc. on the jobs. We've been getting some news that the entry-level salaries have been slashed, the bench strength has been increasing. At the same time, there have been some news of some silent layoffs also. So all these things have kind of spoiled the sentiment as far as the IT sector is concerned. And moreover, I think on the ground reality is reflective of one particular thing. There is definitely a cut in the discretionary spending, etc. And on the other side, we've seen stocks making new highs. So some amount of profit booking looks imminent at this point of time.
Okay, so IT might see some momentary relief today, but the long-term story or the fundamentals are still looking a little bit concerning. We'll come back to that and more. Very quick break. We're coming back with more stocks that should be on your radar today and could see a lot of buzz, pre-open rates, all of that when we return. Stay tuned. Okay, welcome back. You're watching India Market Open. Just about 2 minutes for markets to open on what is a crucial day. And you're looking like we're going to be opening with a good start, nearly 100 points up on the implied open. Nirav Ashar, Shrikant Chauhan with us. Nirav, I want to talk to you a bit about, specifically some of the auto companies, two-wheelers and passenger vehicles. We've seen a bit of a slide there. One of top picks from Shrikant is Mahindra and Mahindra. As a part of the rate sensitives, do you see auto moving? Would you see fresh calls coming in today, and what would you recommend?
Yeah, actually, while Mahindra and Mahindra also looks quite good, we have our preference towards the two-wheeler space, that is Hero MotoCorp and Bajaj Auto. We've seen very good numbers coming in, monthly auto sales numbers. There has been a resurgence in the exports, and there is a benefit on account of two agendas, that is premiumization and electrification. So I think it's a win-win situation as far as the two-wheeler space is concerned. So I think we'd like to stick around with the frontline names in the two-wheeler space, that is Hero MotoCorp and Bajaj Auto, and some exposure to Eicher Motors as well.
Well, the big event is out of the way. About 50 seconds left for the pre-open rates to come in. Keep in mind that we might actually just be flattish based on what most of Asia might be doing. I mean, actually, Nikkei is doing okay, but the rest of the Asian pack is okay. The implied open has improved quite significantly, actually, from being 25, 30 odd points to now being 100 points higher.
Not flattish this morning.
Not flat. But, well, let's see. A lot of times the implied open is flattered to deceive as well. So
I think it's going to be a good morning, Niraj, because look at the several kind of initiatives. Okay, look at this one at one end is fed out of the way, 50 basis point versus 25. And then the amount of capex calls that have also been coming in. Yesterday you had the Nifty CPSE jump up after quite some time. So I think enough to celebrate at our end.
Yep. Hopefully, well, everybody loves a bullish piece. So no surprise or no sulking if indeed the market starts off higher. Let's just wait and watch how much higher it is. It definitely won't be 0.5% lower. That's a safe assumption. The key is whether IT bounces back or not today. Soft landing, 50 basis points cut. Do we see a bit of a dead cat bounce in IT? Or let me not call it a dead cat bounce, but a bounce in IT. So that's the other thing to keep an eye out for. But, we've spoken about IT for sure. The other bucket to focus on, Nirav, is what banks do you buy in? Now, each of these large 5 private sector banks have had their idiosyncratic issues as well. But if indeed domestic cyclicals is the focus, banks fit in there. Foreign money coming in, banks fit in there. Valuations, you want conservative valuations, banks fit in there. So if indeed that's the answer, where within the banking space would you go hunting?
Yeah, so while we already have an exposure to the frontline private sector banks like HDFC Bank, ICICI Bank, but now I think we could start looking at the PSU banks also, that is the frontline banks like State Bank of India, Bank of Baroda, Canara Bank. This, as we already pointed out, that if the RBI is also proactive in cutting the rates, we could see a good amount of treasury gains for the PSU banks also, and I think that would be a positive for them. And we also have our eyes on certain smaller banks, regional banks like say DCB Bank or Catholic Syrian Bank or Federal Bank, etc. We are particularly looking at these banks in a more serious way.
Thank you very much, Nirav. We'd have loved to chat with you longer, but it's seeming like it's going to be quite an action-packed morning for you and for us. The pre-Nifty pre-trade is indicating to a flat start, but expectations are that the markets will do well in today's day of trade. But to get better perspective on that, Rahul Arora as well, CEO of Nirmal Bang Institutional Equities, joins in. Hi, Rahul. Good morning. It's Samina. We've got more than we wanted. Some argue that this is bad economy. Others say it's good politics. What is your view? Do you think the road ahead is looking better than the one behind us?
So good morning, Samina, and thank you for having me on the show. I think it was pretty much par for the course. I think if you look at the commentary that's been coming out of the US over the last 4 or 5 months, general economists out there believe that the Fed was actually running behind the curve. I think they were under a lot of pressure after the ECB cut by 50 basis points. So I think some would argue that they were behind the curve. And then, in about a month and a half, they go into elections. So there can't be any rate movement now between now and the elections. So I think they've just sort of bought a little bit of extra powder and gone ahead with 50. Our own economist, Teresa, doesn't believe that this is going to be the start of a 50 basis point sequence of rate cuts. She believes, if anything, it will be 25 basis points. And, if you go back all the way to Paul Volcker and if you see, the kind of economy and the interest rate environment that was there until now, any quote-unquote recession that has been Fed-led, and this is what the Fed is trying to do, it's trying to cool down the economy by raising rates, has been very shallow and short-lived. So I don't think people are going to be too fussed about this entire rate cut cycle in the US. The only thing is, what could it mean for India? My sense is this will put a little bit of pressure on the Reserve Bank of India. I think they'll have to move their stance to neutral in the next meeting that they have. And we were forecasting our first rate cut in India in February of next year. That may get probably advanced to maybe December's meeting this year. So I think all things considered, even that we're expecting just about a 25 basis point. But I think the market will digest this and move on. Like I said, I think it's a culmination of sort of maybe being a little behind the curve and probably not being able to do another one before the election. So I think all things considered, we're okay.
Okay, so all things were considered, we're okay. Maybe a little better than okay, Rahul. Tamanna here from the perspective of emerging markets, because for us the big question is, are the fund flows coming in now more aggressively, and then where are they going? And Macquarie has an interesting note out this morning where they're talking about NBFCs becoming attractive. Is that something that you agree with, that if you're looking at India financials right now, maybe the upside is on NBFCs from our perspective, and which ones do you like?
So I think from a market perspective, Tamanna, I think if you remember a few months back when we had a conversation, I said that this was going to be a year where India competes directly with capital with the United States of America. I didn't see too many other economies being, beneficiaries of flows that were coming in. And over the last 1 month or so, you've sort of seen the FIs return in some gumption. That could also be a factor of the fact that, the mutual fund industry has done so well and, the size that it has reached. And there was probably this entire feeling of FOMO or the fear of missing out. So they've sort of participated. Now, your question, particularly on financials, is an interesting one because, the one sector that has absolute value in this market today is BFSI. But the thing hasn't been moving, and partly because it is so overowned by FIIs and technically actually underowned by FIIs. So I think if you look at most mutual fund portfolios, you'll find that they're either neutral to underweight banks, and some of that probably found its way into IT and FMCG over the last 3 or 4 months. So that was a technical positioning that funds had taken. Now the question is, obviously, with what has happened with the FIIs in the last 1 month or so, can this be a fillip to the BFSI sector in India? Now, we're talking about a situation where till very recently, banks were hiking deposit rates. Deposit mobilization was a challenge. So there was a talk of extended pressure on net interest margins. But if you get into a situation where people believe that the rate hikes are done and we're going to get into a situation of rate cuts, and on top of that, if you're looking at about a 13-14% kind of credit growth, I think interest in the BFSI sector could return faster than most people are anticipating. The FSI part of the BFSI has anyway been doing well. I think if you look at as recently as yesterday, what were your biggest gainers, right? You had the Bajaj twins, you had Shriram and the kinds that have done well. Insurance has been doing well. So our own sense is we're overweight on this sector. We would play BFSI through insurance. We like ICICI Pru and SBI Life. We would play through housing finance companies. We like HUDCO, which is Housing Urban Development Corporation. We like Repco Home Finance. We love the gold finance theme. I think if you remember yesterday after Powell cut the rates, gold actually had a bit of a spike. We like Muthoot there. So there are pockets of NBFCs where we see value and that we would advise clients to buy even at these levels.
Rahul, you're very, very bullish on everything but pure play banking. What do you feel about HDFC Bank? If you looked at mutual fund data from the last few months, they've actually sold aggressively or sold out of an HDFC Bank. From at this juncture, would you buy an HDFC Bank or would you buy an SBI? Or would you buy neither? That's an option too.
I'd buy both, Samina. I think, if you had an SIP that could invest in 2 stocks, I'd buy HDFC and SBI. I think, we've discussed this before. I think SBI at 16, 17% return on equity is still coming to you at just about 1.8, 1.9 times book on a consolidated basis. is still a no-brainer to me. I think they've got their house in order. There are no concerns on asset quality. HDFC, the consolidated entity, had dropped down to as low as 2 times price to book. I think if you remember, the standalone HDFC Bank at its peak used to trade at even 5 times, and the consolidated entity is giving you growth in excess of 25%. Now, I'm not saying that valuations need to reset to those heydays, but if you look at most private sector banks in India today, the larger ones, they're probably trading between 1.5 to 2.5 times price to book. I think IndusInd Bank would be at the lower end of that, and maybe ICICI Bank at the upper end of that, give or take. It could be a 0.1, 0.2 here or there, but that's broadly the valuation range. I don't think that's paying too much for this kind of sector with the kind of potential of growth that it has. SBI has been one of our top picks for a very, very long time. I know the stock's more than doubled. It's probably 2.5x, but like I said, I think the valuation gap, of about 0.5, 0.6 with the market leader, I think that can still correct by about 20-25%. And I think people are getting too pessimistic on HDFC. I think there will come a time where people will reward this. I think there is some short-term pressures on margins, and I think people are taking that, into cognizance. But for the growth, these valuations, I think, I would actually, try and do an SIP just into SBI and HDFC Bank if I would.
Rahul, morning. Niraj here. As the pre-open rates have settled, other sector that comes into focus is consumption. You know this very, very closely, but I'm asking about a specific bucket, which is the liquor companies as a result of this Andhra Pradesh policy change. Some bit of the rally has already happened, presumably because of that or the market moving up. Is there more juice left here?
So, Niraj, we've been very bullish on United Breweries for a very, very long time. I think we were very aggressive buyers when the stock had dropped down to a 35 times EV EBITDA. I think it's now trading at close to about 53, 54. So I don't think there's too much juice left on United Breweries. You could get a potential short-term trade there, but we did upgrade United Spirits recently. You mentioned one state, there is also Karnataka. So there was taxation and distribution related issues with both these states. Our assessment when we had upgraded the stock a few weeks back was that both these issues on taxation and distribution will get resolved. We do have a situation, Niraj, where by and large, if you look at consumption trends in India, beer is consumed predominantly in summers. Obviously, it helps that you have the IPL and there's a sporting event. But hard liquor is considered to be more a winter kind of a drink. And I think with the festive coming up and getting into winter, and the fact that these distribution and taxation changes are happening, on a relative basis, I think when we look at valuations, United Spirits looks like a better bet to us. I think if you look at consumption as a whole over the last 15 months, this has been the best pocket of the market. And I think you can include names like Radico, Global, Sula. All of these stocks have gone up anywhere between, 35, 40% to about 70, 80%. But I think my expectations of returns from here, Niraj, would be a bit tempered. I think even though we've upgraded United Spirits, I don't think we'll probably look at valuing this company at more than a 15, 20% kind of upside if you were looking 1 year out. I think earnings will continue to give you good returns over the next couple of years of about 18, 20%, maybe even a little bit more if things go right. But we're probably getting towards the upper end of the valuation in this sector is my assessment.
Life highs. Rahul, just stay on life highs for the markets on the pre-open session. So at 9:15, we'll start off well. We have to take in the top call from Srikanth as well. But before that, a very quick perspective from Harsh Seth, our analyst, on the top brokerage call today. Harsh, about a minute 20 seconds. What's the brokerage call?
28% upside is what Morgan Stanley sees on Brainbees. They believe both demographic dividend of India in terms of childcare as well as the potential shift in consumer trend both towards online as well as towards formalized branded retail should help Brainbees in a big fashion. Currently, 75% of their revenue comes from online, 25% from offline sales, in-store sales, and they are expecting, or rather Morgan Stanley expecting 16 to 17% of the top line to be contributed from exports going forward. Mind you, Brainbees also has a Global Bees subsidiary which acquires D2C brands across the world, which should further aid value unlocking. Even if a handful of these companies turn out to be good value for Brainbees, that could be a huge shift or addition in terms of their valuation. Of course, very positive, 28% upside.
All right, Brainbees nearly 5.5% pre-market. I'm just going to get a quick call from Srikanth Chauhan before we get into the opening session. Srikanth, just after you've seen the pre-open settle, Anything that you're spotting? Any call that you'd like to give here?
Yeah, I think like from the current pre-opening rates, if we see any stock, then NTPC looks really good, which is somewhere around 410, 415 sort of levels. There I'm expecting further more upside in the near term as well as in the medium to long term. Technically, it is a very strong candidate, and even if we go through with the news flow, then there also the stock is doing well. Broadly, I'm of the view that the stock is heading for at least 440, but in the near term, we can see the levels of 425, 430. So NTPC looks very attractive at current levels with a stop loss close to 405.
Kant, any pullback candidates on IT stocks today? Nifty IT was, of course, down and out. Wipro, TCS, Birlasoft, Persistent, anything that you'd play intraday for a recovery?
See, particularly from the IT space, Wipro is doing really well. Infosys, Tech Mahindra, XLTech, they are finding some resistance at higher levels. But if we see the pattern of Wipro, then it is forming some rounding bottom sort of formation. And based on that, the stock can even go to its previous highs. I think at this level, Wipro looks attractive around 540, 45 levels with a stop loss close to 535. We can keep a tight stop loss because yesterday we saw a good amount of profit taking. So 535 should be the final stop loss for creating or holding any long positions on Wipro. Again, we can see the levels of at least 560, 65 sort of levels in the near term. And in the long run, based on technicals, I'm targeting 750 sort of levels.
750 on Wipro. Shrikant, very quickly, what are the timelines for such a target?
I think it will take time, Nikunj. It will take at least 12 months. But
12 months.
It's a rounding bottom pattern.
Okay, 12 months, but a longer-term positive target on Wipro as well. Shrikant, thanks so much for taking the time out and being with us today. Really appreciate your time. Rahul, stay on. So much more to talk about, but here's how the markets will look. They look in the green for sure. We'll start off at live highs. The question only is, do we pop the bubbly yet again, or is this going to be a false alarm before a pullback comes in because of a slowing world? Remains to be seen. For now, we celebrate the moment. And about 120 points on the Nifty. So live highs, very good going. Banks participating yet another day. Nifty IT should come up on your screen. Let's just see if IT is doing okay. 1% a bounce back, soft landing, 50 basis points cut. You expected this to happen. The question only is whether this will get sold into or no after yesterday's commentary. Remains to be seen. But good show really. The Sensex actually doing a bit better with the Nifty as well. Let's get the heat map up on the screen. A lot of green, very little red, maybe if anything. ONGC sulking, no surprise. Yet on the brokerage downgrade, HSBC, and no surprise there. But look at the green on the screen. IT, so LTI, Mindtree, Wipro, Tech Mahindra, TCS. The reds of yesterday are the greens of this morning. There is also NTPC, by the way. The NTPC green IPO, very positive commentary in brokerage conferences. So NTPC also is doing well. Bajaj Finance rises and shines yet again, 1.37% higher. There is strength in Tata Motors, Tata Steel. Effectively, everything is rallying, and the Nifty is now perched at the highest point of the day, 25,543. These are uncharted waters, viewers, but it's a spectacular start to the trading day. IT participating, but must say everything else is out there except for ONGC. So it's nearly a perfect start for our markets today.
Yeah, complete photo finish. Shrikant Chauhan called it. He said if you settle above 25,500, then blue sky is ahead, and that's really looking good. Look at it sectorally, Nifty, Realty, all the rate sensitives also moving. So Realty moving, IT making up for poor performance yesterday, banks doing well as is expected, and what should be in the red is in the red, which is the India VIX, because no concerns, at least today. Let's look at the broader indices as well and see if they're participating in this rally. They are. No fireworks as such, but nothing to complain. Over 0.5% up on the Nifty Mid-Cap 150. Let's look at the small cap index as well. That's also about 0.5% and more up. Specific stocks. It's all about the stocks. Garden Reach. Let's start with Garden Reach. They've won an additional $54 million contract. It is on our stocks to watch list, nearly 4% up this morning. You'll see a lot of green today, and NTPC too, because of the NTPC green IPO. Those details out, so 2% up there. Mid-cap IT is recovering as well. We talked a bit about the index, but all of those mid-cap players are not doing too badly. Coforge leading the pack there, about 2% up. Two notes which could see impact, one Godrej Properties and one Adani Energy, both from Jefferies, and both doing well this morning in trade. Impact of brokerage calls also perhaps on First Cry, Brainbees. Morgan Stanley has set a target price of 818, and that is to a flying start. 7%. The reasons I found interesting, India is one of the few countries where population is rising consistently. Good for a company that caters to babies, essentially. Liquor stocks in focus. And a lot to cheer today. I mean, this is the day to break out the bubbly overall and, of course, for these stocks. We spoke to Tilak Nagar earlier today. You saw it first on NDTV Profit, over 5% up on that stock. Radico, UBL are also participating. Samina, I'm sure so are some of the other liquor players. But it's overall a lot to pick from today in terms of what's working in the markets, isn't it?
Interesting, Tamanna, while the broader markets are also doing quite well, there are no runaway gains. So there are very few double-digit movers on the Nifty 500 this morning. The biggest gainer on the Nifty 500 is Info Edge. Maybe this is a reaction to a possible big fall in trade yesterday and some buying that's coming back to the IT bag. So Info Edge is up 5% as we see it, and the volumes there also looking fairly healthy. A few more to touch upon. Irida, let's take a look at that. I don't know whether Tamanna mentioned that one, but with the government looking to offload some amount of stake there, being viewed as a positive, the stock is up 2.5%. So it is turning out one of the top movers in today's trade. Raymond Lifestyle, this one's been quite volatile post its listing. A 6% up move is what we have on Raymond Lifestyle. United Breweries stands to be the biggest beneficiary in terms of volume growth after the Andhra Pradesh market goes through a regulatory or policy change. The stock is seeing a 4% gain in trade today. GET&D, they've also got promoter stake sale plans. That should be, of course, impacting on the market, should be seeing the reaction on that. The stock is seeing a 5% loss as expected. Well, apart from that, you've got, let's check Bajaj Housing Finance. This one's been the story or the top stock of the week. Managed to surprise most people on the street. A small correction there, 2% low on Bajaj Housing is what we have. Keeping it with recent listings, Rahul as well mentioned that gold could be a good theme to play right now. P.N. Gadgil listed on the exchanges only a few days ago. The stock had a fantastic opening. Valuations were also compelling. P.N. Gadgil not seeing too much of that gold share, down about 2%. Keeping it with gold, if you can get a Manappuram, Muthoot, Titan, Kalyan, Senco, these are stocks that usually react to movement on gold prices. And you are seeing a Manappuram that's up 2%. Muthoot is up 2% as well. You've got Kalyan that trades flat. Reliance Infra, I believe there's a board meeting there too. The stock should be seeing some movement. If I can get Reliance Infra up on Senco is up 2.5%. Reliance Infra, the stock sees a 6%, 5% up move in early minutes of trade. So all in all, it's a good setup. No runaway massive moves just yet. The breadth is looking good. Tech is leading largely because of the sell-off that the space saw yesterday. So you saw that weakness that is now getting bought into. The tech sector has been the best performing space in the last 6 to 8 weeks. Most believe that the next couple of weeks and months could be largely driven by banks and or the BFSI space, and that's what you want to keep an eye out on. On the sell side, it's BSA, and this could be profit taking, down 4% in trade. Fertilizer stocks are slightly lower. Some of your pharma names are also seeing some weakness, but nothing too concerning at this stage on the sell side at least. So that's what we have. The market looks good, looks healthy as we see it. I think, Rahul, the next chase will now be to find the next trigger for the markets. The rate cut is behind us. US election shouldn't be too much for us. Is it going to be all about earnings from here on or valuations? Because we do need something to talk about and worry about every day.
Well, I really don't know how to answer that, Samina, because I think, I've got the market calls so wrong for the last few months. I mean, if you were here talking 6 months back and you had said it'd be at 25, 26,000, I'd said there's probably a zero probability of it. See, I think what's happened, Samina, is earnings growth since you brought that up in India, by and large, across sectors, has been a function of margin expansion. It's not been so much top line growth. There have been a couple of sectors here or there, but by and large, it's been margin expansion that's led the earnings growth. Incrementally from here, I think it'll be very difficult to squeeze out very material margin expansions across the board, whichever sector you take up, banks, IT, FMCG, the ones that really matter in terms of weightage. So I think from here, it's going to be more top line driven. Now, wherever you see visibility is where you will go in and buy those particular sectors. We've discussed BFSI ad nauseum. I think probably because you had a slowdown of infra spending in the run-up to the general elections, if that revives in a material way, I think as a second-order beneficiary, we could look at cement. I think that could be an interesting theme to potentially be playing. I think in pockets, maybe there is value now emerging in chemicals. I think that's another space that we could potentially look at. I think IT, since you've been discussing it, while valuations are not cheap, at least we have reasonable free cash flow and dividend yields. So I think there are still some names that can be bought into. So I'd probably, tilt my position more towards banks, cement, IT, and a little bit of chemicals. In terms of triggers, I don't see too much on the horizon. I mean, I think crude's dropped down to 65. Everything is pretty much out of the way. I think if anything, there could be a negative shock that hits us from here, and we need to brace for that because, I'll tell you hand on heart, Samina. I think if you ask my entire analyst team to value their companies on a 1 year forward and put realistic price to earnings multiples and not the PE multiples justified by liquidity, my sense is 75 to 80% of the stocks under my coverage would become sell ratings, and that itself is a statement. The valuations have gone into the land of the absurd, but as they say, it's just about crossing that Lakshman Rekha once. Beyond that, then it's anyone's guess where it could go. So I think it's going to be a trigger like market.
Haven't we already, Rahul, crossed that Lakshman Rekha and several times over? When you're saying brace for what's to come, in your view, what are the possible triggers on the horizon? Where you're saying, and you're right, a big statement, that 70 to 80% of stocks under your coverage could have a sell rating at some point. What is the trigger that you see possibly coming in?
See, I don't know what that trigger essentially will be, Tamanna, but I would remind your viewers that in the run-up to Lehman's crisis, there was a lot of literature written in the US about how mortgage-backed securities were being repackaged and sold and how there was a crisis coming. This literature was actually being written since 2006. Now, obviously, because Lehman happened, we went back and read. So it's, hindsight is always better than foresight. But there is literature being written in the US about the fact that the US economy could be on a shaky wicket. Now, could that be a trigger? I don't know. But, I'll tell you something that a fund manager told me about a couple of months back. He's like, or rather, this was just after the budget. He said, see, Rahul, we've had a pandemic. We've had US interest rates at all-time high. We've had inflation. In India, you've had capital gains taxes, raised. You've had BJP lose an election. He's like, in sab ke baad agar market nahi gira, to ab kyun girega? That to me, was complacency of a different kind. And people now sort of believe that the market just can't correct because a lot of the first-time investors who come into the market post-COVID haven't seen a correction. And I'm not talking about those 1,000, 1,500 point corrections that you've had each, you've had one of those each day in the last 3 months, you've had one day each, whether it was a yen carry trade, the day of the budget, so on and so forth, but they get very easily bought into. So what can correct the market, I don't know. But what I can tell you, is we were the first people on the street to downgrade defense to a sell. And we did that a month and a half back on valuations. People gave us flack. They said, it'll keep doing well. Good luck. But I think, as media and as brokers, we have a fiduciary responsibility to tell our clients and viewers that, there is everything at a price. You can't, just keep buying something because liquidity is chasing it. I think, for example, Niraj is wearing a very nice suit right now. If he's paid 10,000 for it, he might, pay 12,000. But at 15,000, even he may start thinking, do I really need to pay that?
I don't know if you know Niraj enough.
I think that responsibility needs to be there.
Yeah, well, I'll reserve the comments on the suit, Rahul. We can talk about yours.
I hope I haven't underpriced it, Niraj.
I'm saying you're being modest because I know your suits aren't that underpriced for sure. But be that as it may, Rahul. Just one question, though, follow-up here, Rahul. I mean,
sure.
The markets have looked expensive at 22,000 as well, right? I mean, and so the calls of doubt, and if people, I completely buy your point, fiduciary duty to caution at excessive levels, and there were excesses at 22,000 when promoters like Whirlpool sold a year ago or 9 months ago. People said, oh, the promoter knows it best. Why are people buying? And the stock has rallied another $1,000 from there. So, let's take a stand. I mean, at these levels, would you, if you were an individual investor, sit on an X% of cash if you're so negative? Or would you believe that you will rotate into more value accretive names, banks, for example?
I'm so happy you raised that point, Niraj, because, if you go back to pre the lockdown, when promoters were selling stakes, the stocks used to get derated. Abhi line lag jati hai. When promoters are talking about selling stake, people are lining up. But what's very interesting, Niraj, and I'm so happy you raised this point, just look at the extent of promoter selling that has happened in the last 3 months. That number is close to 1 lakh crores, if not higher. And, when I have spoken to some promoters and even some fund managers who've spoken to promoters, a lot of that selling, mind you, has found its way into the market. The source of liquidity may be changing. The kind of promoter selling that you've seen in the last 2 months has been 2x the SIP flows. So last month you saw 45,000 crores of promoter selling. SIP flows were about 23,000. So you had 2x the promoter selling than you had SIP flows. And that money is finding its way back in. So when we talk about sector rotation, which was the second part of your question, you're also having liquidity rotation. You're finding new ways of money coming into this market. Because, if you getting into a sense where promoters are saying, okay, I can make more money by investing in the market than my own business. Look at the discounts at which promoters are selling, Niraj. I'm sure you're keeping a tab. When we as brokers do deals, of even 50 and 100 crores, we are fighting for 50 paisa, 1 rupee. But these are coming at 5%, 7% discounts, and they're happening very easily. These are reasons for stocks to derate. Now, the second part, Niraj, is I'm not saying that I am negative on the market. I'm just saying that you need to be cautious. Because as I was telling Tamanna, I don't know what can hit us. We just need to be prepared for something to hit us. And to your point about sector rotation, which is what I was saying earlier, banks is a no-brainer for me. I would definitely move away from sectors like EMS, anything to do with consumer durables and electricals, anything to do with defense. Some of these sectors are getting very, very overpriced, and most of these are in the mid and small caps. I think I read an interview by Naren recently where he said, there is deep value in large caps. I completely agree with that. Large caps are trading at a substantial discount to their mid cap counterparts. And you guys were discussing IT. Just look at the valuations of everything from Wipro to TCS and compare that to everything from a Coforge to a Persistent. You will get your answer right there of the kind of valuation differential that exists. So I would definitely look at finding value in this market in sectors like cement, IT, banks. Sorry, yes, please go ahead.
Sorry, Rahul, keen to know what you're thinking about the primary market excitement. Are you calling it euphoria? Are you calling it insanity? And are you are you buying into all of the primary market excitement which is coming in? Because that's where most of the action seems to be.
Let me reverse that question, Tamanna. After listing, would you buy Bajaj Housing? That will answer your question.
I think a lot of people were waiting for the first 2 days for an opportunity.
Well, Tamanna, at listing, it's already gone to 6.5, 7 times. What kind of money do you want to make? I think if my memory serves me right, Bajaj Finance at its peak used to trade at that. And there was an operating history of having grown at 30-35% for a very, very long time. I think Group Finance at one point used to trade at 8-9 times price to book, but that was a company that never diluted in its history. So I think one of the reasons why you're seeing a lot of interest in IPOs, Tamanna, is that people are actually bereft of ideas. Let's be very clear. It's very difficult to find a new idea in the market because most of the liquidity is still concentrated in the top 100, 150. You're like, ठीक है, अगर IPO में invest कर लिया तो आपको कम से कम allotment तो मिल जाएगी. Then you can always sell it in the secondary market. So I think that's part of the reason why you're seeing this frenzy, because the kind of money that's coming in, just look at the fact sheets of SBI Mutual Fund, ICICI Prudential Mutual Fund, HDFC Mutual Fund. The number of companies these guys are owning 10% of is not a joke. It is at all-time highs. And in cases where they are not able to do it alone with the funds, they're tying up with their insurance arms and collectively owning. And these are not just mid-cap companies. These are even banks. I think even IndusInd Bank is 10% owned by one fund. I don't think people realize that. So I think that's probably...
So from what I'm understanding, you are skeptical about the kind of frenzy. Are you saying you're not excited by an NSE IPO coming in, possibly a Swiggy?
No. So let me correct you there. I'm saying this is not a statement in aggregation. There will always be exceptions to the rule. Now, look, you had Zomato that listed, went to 200, came down to 40, and then realized that they had to focus on cash flows and profitability, and the market has rewarded them. If Swiggy maintains the same line, you'll obviously see that, there'll be a lot of interest there. That's a very interesting space as well. It's also about which space you operate in. Are you a market leader? Are you a price setter? Are you a disruptor? Most of the IPOs that have come out in the last 15 months don't fit this bill. There will be few. of course, I would say subscribe to an NSE, no question about that. And obviously, BSE has been a beneficiary of the kind of news flow that we've seen around NSE this week. But that's a case to case, right? I think, you've seen the euphoria on Bajaj Finance. To me, ho gaya. I think even at 30, if the company grows at 30%, to be paying 6.5, 7 times book, I'm not so sure. But there will be opportunities in primary markets. That the specific answer I was giving to your question of why I thought there was an interest, because I think in the secondary markets, people are actually running out of ideas because of the amount of ownership they have of individual stocks. That's not to say that I will not say buy an NSE or a Swiggy. We haven't put out research on that effect, but these prima facie look like very interesting issues, and they certainly could be considered.
Swiggy is hot, and how? I believe prices such as 350, 355 are doing the round. And I think any HNI is doing...
I'll just tell you on a lighter note, Samina, one of my friends is actually marketing Swiggy, and, she's a banker, and she's like, my phone hasn't stopped ringing over the last 1 week for Swiggy allotment. So that's, even before the issue list, I'm actually getting first-hand feedback from one of the bankers on the issue that all kinds of people are calling for any kind of allotment. And I'm sure the same thing will happen with the National Stock Exchange. And anything that's
I think Rahul, it's because people feel the FOMO of missing out on NSC. That Swiggy is seeing the sort of inflow that it is. But yes, they are filing a DRHP from what we understand as early as next week, a listing on the cards in the next few months. And of course, the valuations are at a deep discount to Zomato. That's what you want to keep in mind. And they've also done a down round a few months ago. But that's a separate conversation on the unlisted space. Rahul, thank you for joining us. We'll see you soon. But for now, no one can fight the flow of money, and that's what D Street has been witnessing. But Gautam Shah, founder of Goldilocks Premium Research, joins us. Gautam, hi, good morning. It's Samina joining in. It's so good to talk to you today after many, many months. But first up, what is the call on the Nifty? And Bank Nifty has also risen in the last couple of weeks, to all our reliefs, to all our heart's content in that sense. How would you play the Nifty and how would you play the Bank Nifty? Would you buy either of the indexes at current levels?
Good morning. I think as a technician, it's just been a classical bull market making higher tops and higher bottoms. We've had a lot of local and global developments, including what happened last night. But honestly, Indian markets have just stood strong all along. Support levels have worked all along. And I think you don't question such bull markets. You don't question liquidity. You don't question momentum. And I learned this in 2003, 2007, when the entire bull market was fueled by foreign liquidity. Obviously, everybody seems to be talking about the Fed rate cut that has happened. I think more than refueling the economy, it's actually refueling the markets. Because I think a lot of the positives were already in the price, and we wanted some new development which the market can latch on to move significantly higher. And I think with this development, it does seem as if a new momentum on the upside is building up. Any which way, I think the last 2.5 weeks have been extremely quiet. Honestly, the trade has not been in the Nifty or the major large caps. They've all been languishing. But if the index were to get past 25,600 on a closing basis, which I think is a very important resistance, I think that will open up another 3 to 5% on the upside. And I still feel that this is a stock-specific, theme-specific, sector-specific market. There is still a lot of money to be made. India VIX is very quiet. There is no real euphoria. I think with what has happened in the last 7 to 10 days, people are questioning this move a lot more than enjoying it. So I think keeping all of those factors in mind and looking at the charts, and with the comeback of the Bank Nifty clearly, and with global markets doing well, all of these factors put together talk about further upside, but not really in the index, maybe outside of the index.
Gautam, that's such an interesting point because, yes, you are right. The most common verdict is that bahut ho gaya, it's too overvalued, let's get out of it. So I'm glad you're mentioning this. My question is, Gautam, if you indeed believe that the markets, and by markets I don't mean just the Nifty levels, but overall, if let's say the Nifty 500 is to stay stable or move higher, I heard you say the moves could happen outside of the index. Where are those pockets where you believe that people can still make money on the upside? Conversely, do tell us also, where is it that you also believe ke bahut ho gaya?
Well, I personally feel that first of all, on the Nifty, you can't talk about lofty targets, even for the Bank Nifty for that matter. In fact, Bank Nifty has really become a value stock in some sense. I mean, if you look at the valuation and the P ratios of the Bank Nifty and compare it with some of the large cap private names and the PSU names, I think it's value. It's really offers great value. And that's probably the reason we've seen this come back in the last 2 weeks. And with the Fed cut announcement, I just believe that this entire financial services space could do exceedingly well over the next 3 to 6 months. So housing finance companies, insurance companies, NBFCs, banks, I think that's really the big margin of safety trade that we have at this point of time. Some other pockets, that we continue to like would be pharma and IT. I know IT had a down day yesterday, but overall structurally we remain very, very bullish. And the two other spaces which I see are potential big winners over the next 3 to 6 months. First would be metals. I think we've seen an excellent comeback in the last 5 to 7 days. And with what's happened yesterday in the US, I just feel that the metals index is ready for a breakout past 9,600. Once that confirmation happens, we are looking at a 1,000-point move on the metals index. And chemicals, very quietly over the last 6 weeks, we've seen a nice rebound in all the top stocks. Look at the Deepak Nitrate, look at the Tirumalai Chemicals. Many of these names have done very well. So that's again a pocket that we like. And not to forget FMCG. ITC is quietly sustaining above 500, Godrej Consumer, Hindustan Unilever. So these are the pockets that we like. In the mid-cap space, you have to be very, very selective. Auto ancillary, paints as a space, selective infrastructure stocks, sugar, fertilizer. So these are some of the pockets that we like in the mid-cap, small-cap space.
So a lot of calls there, Gautam. Fantastic detail. Hi, Tamanna here, and as always, a pleasure to speak with you. I want to come back to a little more minutiae when it comes to the BFSI space. Are you liking NBFCs? Are you liking a Shriram, a Bajaj Finance? What about your private and public banks? Anything there that you're finding very, very attractive right now?
Well, I think we made this point a couple of months back that Bajaj Finance could potentially be the trade of the next 1 year. And I think if you look at it based on valuations, based on fundamentals, based on visibility, and based on the charts, I just believe at levels of 75, 76, 7,700, you can't go wrong. And I think it's one stock, that could deliver supernormal returns over the next 1.5 years. And not just Bajaj Finance, I think the entire NBFC space, we make a custom NBFC index at Goldilocks. That seems to have, confirmed a breakout in the last 1 week. And it's doing much better than the actual bank Nifty. So I think NBFCs as a pocket, and with yesterday's Fed announcement, it only fuels the rally even more. And I think with RBI likely to follow suit, whenever over the next few weeks to few months, I think NBFC is a space to be in.
Gautam, you mentioned that you like metals. I was telling Niraj this morning that LME inventory is at a record low as we see it. In metals, if you've got to play proxy to commodities, give me 2 or 3 metal stocks you would initiate fresh longs on at current prices. And the fact that money is limited, I wish we could go out and buy chemicals, banks, metals, all of it, right? But that one top stock or sector that you would bet the house on right now.
Well, in the metal space, I think the point that you make when I speak to people on the street and when I speak to a lot of managements, the commentary is that on the ground, it's not all that good. But then when you look at it on the charts, it's not so bad. I mean, you have JSW Steel at a lifetime high today. And some of the other stocks like a Hindalco or a Vedanta are all close to lifetime highs. And I think the sector has gone through a nice 3.5 months of consolidation, and it's preparing to break out. I think a lot of the current negatives are in the price, and the future positives will now get discounted over the next 4 to 8 weeks. So I think JSW Steel and JSPL for me are the top picks. But if you ask me of one dark horse in the metal space, I think it could be NALCO, National Aluminium, which has an incredible chart, very good fundamentals, extremely good sector tailwinds. I think that could be one of the bigger winners. So if you have to really allocate your capital wisely here, it has to be pharma, FMCG, metals and IT. And I would actually stay away from the past big winners, PSU, auto, capital goods, real estate. I would stay away from these 4 and commit into the other 4 which I mentioned.
Pharma, which is the one stock you're buying. I did hear you say ITC is one you like from the consumption space. In pharma, give me one stock that you would go out and buy right now. So
I think Dr. Reddy's is a very interesting setup. I think Dr. Reddy's, Cipla and Sun Pharma. I would go with these 3.
Sun Pharma, ITC, NALCO. Would that be the 5 top stocks you're recommending?
Yes, I would. And Bajaj Finance, not to forget that.
Yes, and Bajaj Finance.
Just Gautam, before we let you go, since we've seen the 25,600 mark on the Nifty, and we started this conversation with a Nifty call from you, do you want to return to it?
Well, I think Nifty is not important anymore. Honestly, we keep talking about these numbers, but if we do get past 25,600, I think the next real stop on the upside is about 26,500. But that's 4% away from where we are right now. I think that as late Rakesh ji used to always say that the trajectory is more important than the magnitude. And bull markets always top out on greed. And where is greed? I see concern, I see fear, I see questions being raised in today's bull market, and bull markets don't top out like this.
Gautam, we have a global guest waiting, but I'm tempted to ask you a 30-second answer if you can. Gold, you've been a big bull. You continue to be a bull on gold?
Absolutely. I think it will do the unthinkable even from current levels. And I think after what has happened last night, I do believe that gold is now ready for $3,000 gradually. And silver could potentially see a 30% rally even from these levels. And I maintain my view that gold and silver will beat equity benchmark returns over the next 6 to 12 months.
Quite a statement. So gold and silver might bleed equity benchmark returns. Gautam, we constrained for time today.
They already have, Niraj, over the long term as well.
But bleed is, well, quite the statement, really. But Gautam, thank you. Very soon, Gautam, we should try and, ahead of the festive season, do a longer chat. Today, constrained for time, we'll have to thank you here, but thank you for taking the time out.
Thank you, Niraj. Pleasure.
That's the view from Gautam Shah of Goldilocks. Enjoy the moment instead of complaining about the upticks. That's the view from Gautam Shah. Let's ask Harold van der Linden, a very important global voice. He's head of Asia Equity Strategy at HSBC. Joins us on this all-important day. Harold, great having you. Thanks for joining in. Do you reckon risk asset investors will have a chance to enjoy moments in the next 1 to 3 months post this Fed rate decision? Is this easing cycle going to be accompanied by upticks?
I think for the moment, yes. What you normally see is that the market has anticipated these rate cuts. And after the rate cuts, normally you have a couple of months of good performance as well. So if you say over the next 3 months, will risk assets do good? I suspect the answer is going to be yes. If you then go a little bit beyond that, say 6 to 12 months, then very often what we see is that markets are starting to come off because the very reason for the rate cuts is that things are slowing. And what we've seen in the past, doesn't have to happen this time around, but what we've seen in the past, that markets after 6, 7 or 8 months after the initial rate cuts start to drift lower again because worries about growth starting to come through. And so we'll have to see over time if that's going to happen again this time. But for the next 3 months, I think this is positive for risk assets.
Harold, good morning. Great to speak with you. Just to get a sense of what is the view now on emerging markets like India. From the Indian perspective, the rate cut paradigm shift becomes very, very important to understand where global flows are going. What would be the view?
Yeah, so the view is that these rate cuts will be positive for emerging market assets. And we like risk. Emerging markets is more risky than developed markets, so that's good. And what you're going to see is that because it doesn't make as much sense now to keep money in money market deposits anymore in the US, you want to put money somewhere else, and equities and Asian equities will fit into that as well. In addition to that, what we also see is that appetite for the Japanese market is cooling. So you see that money is coming out of Japan. That doesn't have to go into Asia, could be going somewhere else as well, but that's something to keep in mind as well. So there are two sort of dynamics that is good for Asian markets. And then the question is, of course, will they go to India? Now, the funny thing is that for global fund managers, they're underweight on India. That's got nothing to do with their view on India that has been negative or so. On the contrary, most of them are positive. It's just that they feel uncomfortable with the high valuations, and the local investors have bought up that market, right? So they've pushed the foreign investors out. So the question is, will they come back?
Sorry, just the point on India, if I can just ask a quick follow-up. If not India, then where else? I understand the valuations are uncomfortable, but for global money seeking a destination, what then is the alternative?
Yeah, that's the real problem here. You're absolutely right, because let's go around the region. Japan, we see the yen strengthening is no good for equities. In Taiwan and to a lesser extent in Korea, the AI rally seems to fizzle out. So then you got, of course, India. China, the problem with China, of course, remains growth. And the appetite for China is not extremely high. So real good news got to come out of China in order to absorb that money. And that news is not there yet at this particular point in time. And then actually the other great story in the region is ASEAN, but ASEAN is small. So if we take that out of the equation, because it can't absorb the money that in India can, you're right, where else can it go? And that is the problem. That's, excuse me, that's exactly what you see in markets, that people struggle to buy more India because it's too expensive, but they are actually almost neutral in China because if you don't have much more in India, where else do you put that money? So you end up being neutral in China. That's right.
Harold, hi, it's also Samina joining in. And if you're buying India, and I know you've said this before, that India is where China was maybe 20 years ago. So the road ahead is looking very glorious for us. And everything seems to be coming together. You do like banks, from what I remember last. You also did say that while the balance sheets were strong, things could be slowing down. At the current juncture, with a rate cut in the US and anticipated rate cut in India, which could help balance sheets for Indian banks, would you buy Indian banking names?
The short answer is yes. But I do see cracks starting to appear in the Indian story. We know the Indian story is great, GDP growth is great, and there's a lot of sort of formal retail takes market share for informal retail. I do see the first cracks to the Indian story appearing, but it's not something that is going to keep me awake at night, and also doesn't mean that I think that this is the time to exit that market or so. On the contrary. And those cracks appear in the banking system, to be honest, because you see that they struggle to keep the deposit because everybody's putting it in the stock market these days. So there's pressure on margins starting to come up, and delinquencies in some of the personal loans is picking up as well. But broadly speaking, you want to have banks or companies in general in India that have distribution capabilities. If there's one thing where India is unique as against China, you're right, a lot of things look like China 20 years ago, but where India is unique, you need to be able to distribute in India. That is one of the most difficult things to do. And banks and retailers and these sort of companies, they can. You get good distribution to a large part of the population that is growing and willing to spend more money on a mortgage or a car loan or maybe on cosmetics or something like that, then you're in a really good position in India.
Harold, would you tell investors sitting outside, including yourself, to add incremental capital to Indian markets right now? Or will you wait for a better time and opportunity, because the fear of missing out is also quite real for these markets?
Yeah. So basically what we tell people, when it comes to India, you have to ignore the valuation for the moment. It is just, it is expensive, but the underlying momentum is good. And as you or your colleague just highlighted, what are the alternatives in the region? Where else do you really want to go? Yeah, Indonesia looks interesting. The Philippines look interesting. Those are smaller markets. Taiwan is struggling with AI. So that's a problem as well. So Korea is where people like to go. China is where some of them go, but it's really concentrated in a few stocks. And in India, you get a broader sectors, a broader selection of stocks where you can go to. It is expensive. We just have to digest that for the moment.
Harold, the question then therefore comes is how expensive can expensive become? Because some people argue that Nikkei, when it topped back in the last century, topped at 60 times multiples. We are still at 22 times.
Yeah, that's right. I think you've got to be careful what you wish for, because it sounds great if you can go to 60, but remember that the Nikkei then fell for 25 years thereafter. So then you got 25 years of bad market performance, right? Listen, I think if you trade as a market on 20 times, but you can deliver also about 20% earnings growth, and this year and next year, and maybe the year thereafter, as long as that visibility is there, I'm happy with those higher valuations. If we see that that visibility starts to disappear, or earnings disappointments come through, or we see that banks or certain consumer companies start to struggle with their businesses for whatever reason that may be, or we see other excesses in the market of people taking on way too much loans to put it into the stock market, which is something you got to be always really careful to do so, then I think you're getting to a situation whereby, hey, we got to be really careful here. That's exactly what happened in Japan. In 1987, 88, 89, the market was boom, 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 going up like in India. But eventually, when it started to come down, a lot of things started working in a negative reaction, right? people had used stock as a way to borrow some more money. And if the stock goes down, well, then you have to repay your money suddenly. So you got to sell even more stock to repay that money. And then the the dynamics move into an opposite direction. Now, we're not there yet in India, and I hope we don't really get there. What you want is good growth, steady growth, visible growth, and a steady pickup in these markets.
By no means was I wishing for that 60 times, just making a point, trying to get a view.
I get your point.
Harold, we keep talking about this and we keep worrying about how China is doing, and the fact remains that metals are reeling under pressure. No matter what happens to the dollar, and you may see that weaker currency, positive commodities, all that play out, fact remains demand on ground is a huge problem. Do you not worry that this will play catch up?
That is a problem. We know it's a problem, and that's one of the reasons why demand for certain particular materials continues to be weak. China has got a growth issue, and that comes from the real estate market. The funny thing is, in China, in Hong Kong and Singapore, just to give you an idea, and in China, onshore China, it's the same, but in Hong Kong and Singapore itself, it's almost 2 trillion, and that's with a T, trillion US dollars. Stand on the side. People hold it because they do not feel they can invest yet in China. The amount of money onshore in China that is held in deposits, where they cut a deposit rate in China gives you maybe 2.5% these days or something like that. But they keep enormous amounts of cash on there because they feel uncomfortable investing. It's exactly the opposite of what's happening in India at the moment. We need to see a catalyst for that money to be employed.
Okay.
I don't know what that catalyst could be, but there's a couple of things that could help. But at the moment, that's just clearly not the case.
Okay. Harold, just one final question. And this is about whenever you have good news, euphoria, excitement, we're definitely seeing that in Indian markets right now and globally as well. Then come those who are saying that there's going to be a big downfall. They're pulling out historical data, what happened in 2007. Just wondering if you're looking at any of that historical data at all, and are you buying into this sense of foreboding, or is it that people just don't want to enjoy what they're seeing?
No, I do look at the history a lot. I teach a class about it at a university in Hong Kong. But I think you got to also understand, for us to look at markets, we try to understand history in order to understand how things worked in the past. But it doesn't mean that's going to happen in the future. So we need to look at India equities on its own merits. Is growth good? Yes, it is good. Is it visible for the next 1 or 2 or 3 years? That means, are the underlying trends very easily identifiable and understandable? Yes, it is. Are the valuations excessive? Well, compared to the region, yes, but it's not, as your colleague just mentioned, it's nowhere close to where Japan was. So as long as these fundamentals are in place, this can continue. It's easy to call for a downturn because as long as you call at some point in time, you'll be right. But I think that's the wrong attitude at the moment yet. Yes, there are cracks appearing, but it's not something I would say, hey, it's time to take money out of the market. So far, India looks good.
Okay, so far India looks good. Pleasure speaking with you, Harold van der Lind there. Always an interview with him leaves you with so many quotable quotes at the end of it, and this is no exception. We have to wrap it here, though, on India Market Open, and we're doing that at a record high, so no complaints there at all. Very quick break, but stay tuned. Up next is Talking Point.
Thanks for tuning into Talking Point. I'm your host, Niraj Shah. It's the day after the Fed rate cut, and the case for a chat amongst all things global that we'll talk about to our guest also is local. What are the sectoral beneficiaries of rate cuts, if any? Because rate cuts in India might have a delayed transmission relative to what's happened in the US. But independent of rate cuts, are banks better placed amongst the valuation concerns that surround a lot of other sectors? And while IT is sulking generally, is IT outperformance around the corner? In fact, in an era of an easing rate cycle, tech tends to come to the forefront. And let's talk about all of this and more with Niraj Shah of Envision Capital. Nilesh, great having you. Thanks for taking the time out. Really good talking to you today on such an important day. How are you viewing the commentary from the Fed? The fact that they did 50 instead of 25, of course, so that's woven into my question. And the outlook for risk assets, given the fact that we are in an easing cycle, even if it's not predictable, 25 basis points each.
So, Niraj, at the outset, I clearly believe that this rate cut honestly augurs well for risk assets or riskier assets, or where the volatility could be high. So clearly, I think this is very positive for emerging markets. And within emerging markets, this obviously is even more positive for India, which essentially has been outperforming relatively and outperforming by a very big mile. So to that extent, I think it's very positive. It's positive for riskier assets. It's positive for emerging markets. It's positive for India. Specifically for India, why it's even more positive? Because I think clearly over the last 3 years or in the post-COVID era, FIIs or FPIs have been relatively underweight and have not been able to catch up with the rising weights of India in emerging market indices. So to that extent, it's quite possible that with interest rates coming off, I think they could basically come back and increase their allocations to India. So I think on an aggregate basis, on the whole, this is directionally positive.
Okay. Nilesh, I asked this question to now everybody, right? And it's pertinent because you can think of India as an expensive market in an idiosyncratic fashion, because valuations could be maybe a bit stretched in a lot of cases. A lot of cases maybe not so as well. So if you were not necessarily an India dedicated portfolio management service, Nilesh, would you choose other markets over India, considering that India is growing well, but a lot of others are not, and maybe Japan is, maybe Spain is, but not a lot of other markets are. So would you choose India over other markets or other markets over India? Part one of my question is that. And part two, that if you were choosing India, would it be a low overweight with very specific buckets, or would you continue to stay overweight India because growth will take care of valuations?
Firstly, Niraj, I would be overweight India. I think the narrative for India, I clearly believe, is strongly more compelling compared to the other opportunities that one has in global equities or emerging market equities. Look at the large pockets. What are the large pockets? It's India, Brazil, China, Russia. Okay, I mean, just these four are the very big pockets. You could add Southeast Asia as the fifth pocket, which is a combination of Malaysia, Indonesia, Philippines, and that basket, and Vietnam maybe. Clearly, India right now offers growth. It offers stability, political stability. And it offers essentially multiple kinds of opportunities. You really don't see some of the other economies having this breadth of opportunities, and a very large extent of policy certainty. These are some of the strong factors which go in favor of India. India is still at a very early stage. I mean, I think some of these other economies, they are already at $10,000 per capita or north of $10,000 per capita. In fact, the biggest risk out there is that will they face, or are they already facing a middle income kind of a crisis where you get to $10,000 and then you basically struggle your way up. India is yet to get there. We are still at about $2,500 or $3,000 per capita. So that gap between $3,000 and $10,000 is still massive. And it's going to take 10, 12 years or maybe around that time to kind of get there. So in that period, which is probably the next decade or so, India basically is well poised to deliver higher growth backed by strong policy response. So I think these are some of the things which go in favor of India. Now, in India, what does one do? I probably think that the two most powerful themes are around digitization and urbanization. These are the two most powerful, most strongest, or most structural opportunities, and therefore one would look out for bottom-up opportunities in these two very powerful themes from an India portfolio or India allocation point of view. And I think it calls for being seriously overweight on India. You could basically kind of differ on timings, whether it is now, or whether it is 3 months later, or maybe 6 months later. But clearly, I think the case for India is getting more and more compelling, and therefore calls for essentially higher allocations to India.
Nilesh, could you exemplify why do you believe these are the two most powerful themes?
So, Niraj, clearly, if we look at urbanization, I mean, we're still at about 35%, 65% still is in rural areas. There is a shift happening from farms to factories, and you're going to see more and more people come and live in some of the towns or the smaller cities or even some of the bigger cities of the country. And a lot of basically villages also improving. So clearly there's a shift towards urbanization. You're seeing nuclearization of families, and you're basically seeing the dependency ratio essentially kind of get better, which means that you now, instead of just having one person in the family earn, you're going to have increasingly two people in the family earn. So what all does this mean? It will mean more consumption, better homes, better appliances, better education, better healthcare, and some of the other kind of areas. So you're going to see all of these opportunities. So clearly for the next 5-10 years, the demand for most of these pockets should be in kind of double digits. So that I clearly believe. So this whole journey from maybe 30-35% to 60-65% is probably going to take 10, 20, 30 years. And you really therefore don't find a comparable opportunity globally. And this is the journey which all other underdeveloped or developing economies have gone through, especially our Asian peers. They've all gone through this whole spate of urbanization. So clearly believe that this is a very, very strong phenomena. The other strong phenomena is basically digitization. We are seeing how digitization is making inroads, especially over the last 10 years. The whole technology adoption, the rise of the millennials, the rise of the Gen Z, and their comfort with using technology to trade, to save, to invest, to bank, to consume, to transact. And that's become a part of living now, or increasingly becoming a part in a significantly bigger way. So clearly, therefore, businesses which are using technology essentially are emerging to be disruptors, challengers, and eventually champions. And this kind of a journey, which individual businesses are going to essentially travel or are going through right now, essentially can be very, very big winners and very big wealth creators. So clearly these two pockets, in my view, are essentially the two most powerful themes and the two most powerful opportunities from an India standpoint. And I clearly believe that these are unparalleled opportunities from a global standpoint.
Nilesh, can I urge you to try and tell us, when you think about I'm presuming, I'm not saying you're specifying names, but I'm presuming when you're talking about companies using technology, for example, right? The Zomatos, Swiggies, PB Fintechs, etc. of the world come into the picture. Help us understand how you think about it, because again, it's very easy to get caught in the argument that the stocks have rallied 4x, 5x from the recent 1.5 year lows, and therefore they are baking in some of the optimism. So when you are thinking about these themes being multi-year themes, how do you think about it? Do you think about Zomato as to what it will be, say, in 2030? Do you think that far out? And if so, how do you think about these businesses as to what they could be in 2030 and therefore the resultant stock price movements maybe?
Sure, Niraj. I think that's a very, very pertinent kind of a question, and honestly, it's worth a slightly even a longer debate. But sure. Basically, just to kind of summarize that, any of these individual businesses, Niraj, they are essentially addressing very large underpenetrated kind of markets. they are essentially solving a problem. They're trying to kind of make life easier for consumers and deliver to them a solution in the most efficient and effective way. So I clearly think that's essentially the big premise. And because of this large opportunity and the fact that they have been able to develop a very strong technology stack and have been able to execute very well and have been able to kind of build scale at speed. I think building scale is one thing, but to be able to do it at speed and with excellence, I think is quite phenomenal. The fact that now most of these businesses have become a bit profitable, or there is a path to profitability, I think therefore to that extent they've crossed that proof of concept stage. And just to kind of in a very kind of a short way, I probably think individually, each one of these businesses could potentially be 10 times larger, maybe in the next 10 years. Which is that they either grow their revenues or they grow their operating profits or they grow their net income at probably a 25% CAGR over a 10-year horizon. It may not be individually every year, but over a 10-year cycle. And so potentially, basically, these businesses will be 10 times larger. And even if valuations were to correct by 50% in any of them, they could still potentially be 4 to 5 times bigger as in terms of their market capitalization over a 10-year time frame, which I think is fantastic, because I think even over 10 years, the Nifty, what it delivers is probably about 10 to 12% annualized return. So in that context, which probably is around 2 to 3 times in about 10 years, versus that, these could potentially be 4 to 5 times, assuming that the businesses just end up being 10 times and not even more. So I think that's the way to really look at it, that don't just be focused on short-term valuations, but I think in the first place, be more focused on the long-term opportunity and how big these businesses could be in the next 10 years.
Interesting thoughts there. By the way, viewers, some news flashes on your screen about IIFL and the credit rating cut that has come in and what it could do to the business. So that's a stock you want to keep on your mind as well. 5% lower as we speak. IIFL Finance faces a downgrade risk on the gold loan ban, and as from Bloomberg coming in and say that IIFL Finance may cut more than 9,000 employees if the ban persists. Pertinent things. Now, the other end of the equation is if the ban indeed goes away, what happens to that? So remains to be seen, but these are pertinent things that the credit rating agency, whichever it is, has put out, and it's showing in the way the stock is doing. Let's try and talk about that end of the business and financials. Nilesh, the two more pertinent things to talk about. One, that if indeed global money is to come into emerging markets and India, then it will, and somewhat of it would be passive in nature, it might find its way into the highest weightages, and therefore banks and BFSI comes into the picture. And from maybe a global investor's perspective, when they look top down and look at valuations which are not looking expensive, banks might feature in their list as well. Do banks feature in your list as a result of these arguments, plus maybe impending credit growth and what it could come in? Or are you at the other end of the street? Because I hear a lot of people saying that we don't want to do anything with banks because there are other pockets which are better to invest in, because I'm not a global fund and I don't have a compulsion to necessarily marry myself to the index weightage.
Yes, clearly, Niraj, the street is divided on that. I mean, I've never seen this kind of, for want of a better word, polarization in terms of the thought process as far as banks and lenders go. So I think, yes, this is honestly very, very topical. And my views, I mean, in the first place, we own banks. We own, all the 4 top private banks in the country. We own 2 of the mid-sized banks as well. So we actually own about 6 banks, plus a whole bunch of other financials. I mean, we own a home financer, and then we own 3 or 4 online fintechs, if you may call them. So probably at least a couple of them. So I think all in all, I probably think we own and we have 8 to 10 positions in the entire financial space, of which 6 are banks. So we clearly believe that, I think, yes, the banks, the large banks have underperformed. The smaller banks, of course, have done relatively well. But the larger banks have underperformed because there has been significant over ownership of them. I mean, if in the pre-COVID period, that was really the biggest allocation. And that obviously has changed quite meaningfully and dramatically in the post-COVID era, as essentially the ownership challenge has come. But clearly believe that, honestly, at least from a near-term perspective, expect banks to essentially catch up with some of the underperformance that they have demonstrated. And purely because I clearly believe that a slightly benign liquidity environment helps banks. It essentially helps them to raise liabilities better. It helps them to essentially, therefore, earn better spreads. So I clearly believe that this is not the time to ignore banks. This is the time to be constructive on banks, especially some of the private banks, and so clearly see more increasing allocation towards that. Number one. Number two, Niraj, I think global investors have been essentially under allocating to India in the last 3 to 4 years, okay, especially in the post-COVID period. And if they have to put to work large capital, clearly I wouldn't be surprised if the large banks become amongst the first port of calls. So these are some of the reasons, apart from, of course, the fact that they will continue to demonstrate steady performance, are some of the reasons why we believe that banks are well poised to outperform here on.
Okay. The argument, Nilesh, that some people make about how banks are not the only source of borrowing right now for corporates, because they have other sources, and therefore the credit growth of banks need not necessarily be commensurate to the growth of capex in the country, and therefore they may underperform. Is that a valid argument, or are there chinks in that argument?
No, I probably think there are chinks in that argument, Niraj, because clearly capex is not going to be the only driver of credit in India. There are two other pockets, which essentially is the working capital requirements of businesses.
Okay.
No matter how big you are or how small you are, you need working capital. You are not just into the business of building capacity. I mean, after building the capacity, you've got to run a business, you've got to manage working capital, and higher growth, higher economic growth, higher business growth calls for more working capital. And clearly the banks are in a vantage position to provide working capital requirements and take care of the working capital requirements. So clearly, I think that's one area. And two is, even on the retail side, even now, a very large part of that demand is being met by the banks, even on the retail side. I mean, look at the retail portfolio, the size of the retail portfolios of banks versus the size of the retail portfolios of the other players, the non-bank players, or, maybe even of the fintech. So I clearly don't think, Niraj, it's an either or. I think you buy banks to essentially kind of provide stability to your portfolio, and you probably buy specialized non-bank lenders or some of the other fintechs to essentially for either higher growth or to basically focus on opportunities which banks are not well placed to do, which could be online savings, online investments, online insurance, the world of payments. I think these are very, very interesting hyper growth opportunities, which I think banks are not relatively well placed. So I think you own banks for the credit requirements of the economy and for the stability to your portfolio, and you own some of these bottom up online fintech plays or specialized lenders to take care of, not just the credit opportunity, but many other opportunities like protection, payments, and investments.
Got it. Okay, Nilesh, the other aspect is IT, and that is befuddling me and befuddling a lot of people, right? And yesterday's comments from TCS at an analyst conference, or Accenture supposedly saying in an internal memo to people that we will do these promotions after 6 months, and people saying, oh, that points towards stress. I'm just trying to understand, is it just a very difficult environment to predict even for companies? Because the commentary looks slightly chalk and cheese in a matter of 6 months odd. And how do you think about it, therefore? Okay, let's start with that question first.
So Niraj, I think clearly, when we look at IT and I think we need to really look at, say, the top 4 or 5 players, and then we look at the next bunch of whatever, 20, 30, 40, 50 companies which are there. The top 5 companies, Niraj, even over the last decade, have struggled to grow north of 10%. Okay, I think if you were to kind of look at if you were to basically take away the depreciation of the currency or the strength of the dollar, I think in dollar terms the growth would probably have been at best mid-single digit. Okay, and then if you were to further take out acquisitions, the organic growth though would still be probably just about that 5% odd level, or maybe even lower. So I clearly believe that even over the last 10 years, these big companies have probably at best grown at about 10%. Obviously, they have been fantastic capital allocators. They have essentially undertaken year-on-year buybacks, which have shrunk the equity, improved ROE, and contributed a bit to the earnings per share growth. So I think if you're looking out for those, those 10, 12% kind of returns, maybe that's a good place to be in. But I think going forward, the risk of automation, the risk of AI being increasingly adopted by the Fortune 500 companies and the kind of huge hundreds of billions of dollars of investments which whatever the Magic 7 have are kind of undertaking. Clearly, what it implies is that the headwinds for the large Indian IT services companies or the big IT services companies are only going to magnify further. So I think one needs to kind of look at them in this backdrop. I mean, they continue to be capital efficient, they can score high on governance, and they're fantastic capital allocators. But I think they will fall short of growth. So to that extent, I think one has to be very careful about allocating to them. Having said that, but there are very interesting opportunities in the tier 2, tier 3, tier 4 space, where there are specialized IT services companies which are doing engineering, R&D, which are focused maybe just on the BFSI space, have interesting products, platforms on that side. That's really the space to kind of really be focused on for higher growth. And I think probably that's where investors ought to be, rather than the very obvious top 4 or 5 names. The top 4 or 5 names would, I think, be nice short-term opportunities when they kind of when the valuations are slightly below their long-term averages. You buy into them and play for that valuation arbitrage or P arbitrage. But I think beyond that, they clearly don't seem to be the best of growth bastions.
Okay, so well, it's a surprise, not a surprise really, but it's an interesting point, viewers, that here we have a smart money manager talking about focusing on the mid cap and the small cap or the mid-sized IT companies as opposed to large caps, whereas the common narrative is that large caps are way cheaper than the mid caps. But maybe there is a reason for that to happen, I guess, and I think Nilesh kind of briefly enumerated it. Just wanted to mark that in today's session, mid caps and small caps have come off now from the highs of the day, so bear that in mind. But Nilesh, sticking to this point, what businesses, I mean, are these in the ER&D space? Are these product companies, or are these pure play IT services companies? I'm not asking for stock recommendations, but just trying to understand which are these businesses which are doing good work. They may not be good stocks to buy because they may be overvalued, what have you. Just trying to understand this. Which space do they belong in? Even if you can't take names, what buckets do they fit in?
So they fit in all the 3 buckets that you alluded to, Niraj. I think the R&D space is very interesting. The engineering R&D space, where we have a bunch of high-class companies which are delivering solutions around engineering, R&D, product development, to a bunch of automotive companies, to aerospace companies, mobility, high-tech, manufacturing, that space. So they're not those conventional IT services companies which are essentially deploying enterprise-wide solutions for the big companies, but they are providing some very, very specialized engineering and R&D oriented solutions to some of these very high growth sectors. So I think that's one. The second essentially are product companies. There are a bunch of product companies which have either core banking solutions or some of the other solutions around the core banking solution. targeted towards the BFSI space, the global BFSI space. So I think that's a very interesting kind of a space or an opportunity. The third in services, Niraj, I think it's still a bit early days, but look out for companies which are developing very strong AI practices, which they can basically then execute and implement for their clients. Mind you that in the next 10 years, the spending around AI is going to be huge. Obviously, we are not going to we won't have sufficient AI creators, but we are definitely going to have several companies which build strong expertise in deploying AI solutions for global companies and for global businesses. I think that could be a very, very interesting opportunity. And fourth, essentially, is maybe some very selective SaaS companies, which there's a strong overlap with product companies, which beyond BFSI, but probably around travel, hospitality, and maybe some of the other areas. So these are the kind of 4 buckets that I think investors should increasingly be focused upon.
Got it. Nilesh, such a pleasure talking to you, but that longer conversation, you gave us a very nice, succinct answer, but the longer conversation on some of the consumer tech companies awaits us. We'll do that very, very shortly. Thanks for taking the time out and joining us today, though.
Looking forward to that opportunity, Niraj. Thank you so much.
The pleasure was ours, and viewers, thanks for tuning into this edition of The Talking Point.
Markets cheer the Federal Reserve's 50 bips point rate cut. Nifty trades about 25,500, while the Sensex trades at the 83,500 mark. Sectoral indices trade mixed. Media, oil and gas drag, while FMCG and auto lead the gains. And SpiceJet surges as much as 8% as its QIP attracts investments from marquee investors like Madhu Kela. Proceeds to be utilized towards clearing its dues. And the Andhra Pradesh cabinet approved the new liquor policy, adopting a private retail system. NTPC trades higher after its arm NTPC Green files papers for its IPO. The company aims to raise 10,000 crores. Welcome to the FNO show. We've got Agam back for all the FNO action as well. But Agam, we've missed you. But you've come back on a day when the much anticipated, much telegraphed event is finally behind us.
Yeah.
Fed gives more than the markets anticipated, but the markets, while positive, aren't euphoric about it just yet.
Yeah, sure. So a couple of reasons here, of course, Samina. While we saw the Nifty make a new lifetime high yesterday, to a certain extent, this event is now being factored in, and we're starting to see a little bit of profit taking, not just in global markets, but in Indian markets as well. That's not to say that we did, in fact, make a new lifetime high today as well in early opening. So I reckon that some traders are taking this as an opportunity to perhaps book some profits going ahead. And there's a high likelihood that we could potentially see some consolidation from here on. Do remember that we don't have any huge events lined up over the course of the next couple of weeks, a few weeks. So that's something that a lot of traders will have on their minds. And based on that, I reckon that now is the time when they feel that it's potentially good to perhaps go ahead and book out of whatever gains they've already made. But with that, let's also take a look at how things are faring as far as the futures and options space is concerned. So we'll take a look at the futures, as far as the futures go. Well, the Nifty is currently still up by about 0.5%. It's still holding on to 25,500. And with that, we've seen an increase in open interest of around 3.5%. But because of the fact that we have seen the Nifty come off quite a bit from day's highs, I would still question whether or not this increase in open interest is towards shorts or longs. As far as the Bank Nifty is concerned, do remember it was a good day of trade yesterday with an up more around 1% yesterday, another 0.7% up today as well. And we are looking at a very marginal increase in open interest of around 1%. As far as the option markets are concerned, today we have the weekly options expiry for the Nifty. And while we had a significant amount of call writing, or rather calls being written at around 25,500 until yesterday, a lot of those calls saw unwinding earlier on in the session. And since then, it does seem like we've seen the Nifty come off. Look at the puts as well. We have a lot of traction around 25,400 and 25,500 in terms of puts. So perhaps that'll be a level to keep an eye on. It may serve as a little bit of a fulcrum, to speak for. So 25,500 is what we're looking at. And let's see whether or not in the Nifty, in fact, ends right at that mark.
Yeah, and I think beyond the Nifty, it's the Bank Nifty that's turned out to be the star over the last couple of weeks. After months and months of underperformance, the catch-up is obvious. The street quite excited about how Bank Nifty has been doing. It slowly and gradually moved up quite well over the last few days of trade. This morning, too, the picture doesn't look too bad. 0.7% high on Bank Nifty. September futures in a premium with an increase in OI. So the bias clearly remains on the upside. Beyond that, you've got pockets in markets that are doing okay. But the rest of the market, like Agam said, could have anticipated that price hike, rate cut that's already in the price from the look of it. Broader markets are seeing some action, but they're largely domestic-facing companies that are doing well. You've got lots of those alcohol names like United Breweries, the Lucknow Industries having a pleasant day on back of the regulatory change in Andhra Pradesh. Real estate isn't doing too badly. Counters like VIP Industries are doing well. Info Edge is having it quite pleasant after a double upgrade. IT that led the losses yesterday, if we can quickly pull out what IT is getting up to. isn't really seeing much of a material pullback in today's day of trade. The VIX has dipped sharply, usually happens after the big event or any event is behind us, an 8% drop on the India VIX, and the IT index continues to reel under pressure after yesterday's sell-off. So no recovery despite the fact that rates in the US will be lower, business will pick up, not having an impact on IT stocks. Remember that the IT index is up over 30% in the last 8 weeks. Nilesh Jain and Shilpa Rath both join in with their trading strategies and perspective. Nilesh, I'll start with you. I do understand that the star of trade is going to be Bank Nifty and not Nifty. But nevertheless, a trading strategy on Nifty, and what do you recommend investors or traders to do on Bank Nifty at current levels?
Very good morning to Samina and everyone. So today, if you look at, as you rightly pointed out, that Bank Nifty is definitely outperforming. Is not today, only today. It's been from last 3 to 4 consecutive sessions now. Although the structure for the Nifty also looks strong, and I would advise at